Yes.
Right. So, also, a lot of these companies are coming off the back of some earnings-related news as well. So if you look at Charter, CHTR is the ticker symbol on this, up 28%. So it's on pace for its best monthly gain on record. I was using the SINS function here to find this.
Look
So
at you going
that's
all
another one.
deep
But
into the Bloomberg.
of course, we know that with the S&P 500, when it comes to the weightings, I also look at the point gainers too. So actually, Apple, AAPL, is up on a point basis here, up around 19 points here. And that does come off the back of, in the first quarter, Apple actually posted one of its worst performances relative to the S&P 500. I think it was about its fourth or fifth worst since the dot-com bubble burst. So coming off of the back of that, we've seen Apple rebound a lot. Obviously, since then, early May, when it had its prior earnings report, obviously we're going to hear from them tomorrow after the bell, but that's when they announced that historic buyback program. Obviously, they still have to execute a number of that, so you are seeing that too. But then Tesla's another one that is one of the stronger point gainers here in the S&P 500 this month, followed by Berkshire Hathaway for that Class B shares. But if you want to look on the flip side of that, Dexcom, so last week it did report earnings, had a huge decline actually if you're looking what happened to it last Friday. So at that point it dropped 41%. That was its worst drop ever. So it did cut its full year sales forecast though. But if you are looking at that, it's one of the worst decliners here in the S&P 500 this month, down about 40%.
All right, decent report there. I'll give it a decent report.
You stumped Paul. He did nothing.
She's on radio, she's on television, but her day job is just as a reporter for Bloomberg News, talking about the markets. You published a story here, traders face off against Fed at worst time of the year. And this goes to an issue that it definitely, because I was scarred early in my career by this October time period. October's not good for the market, but really September as well. And
well, actually, October has a bad reputation, but it tends to be a bear killer. So if you go look back and think about the low, the bear market low in 2022, also we had that low in the S&P 500 in October of last year. Obviously, that wasn't the bear low, but we did see that trough last year. So it does get a reputation for being bad, but it actually is the most volatile month. So the worst month is September, and followed by that would be August. So you can use the SEAG Go function in the terminal for seasonal. SEAG. So that is where you can look at the heat map for, you can only use it for the S&P 500. You can also use it for other stocks or either other major indexes. But August, if you go back the last 30 years, down about 0.5% on average. And then in September, it's down about 0.7% on average. Obviously, we know sometimes we don't always see that happen, and stocks can definitely buck that trend. We are in an election year, so it's interesting. Jeff Hirsch, we've had on radio here before. He's the editor of the Stock Trader's Almanac, so he compiles a lot of the data historically. So he actually, for this, he was looking specifically at the NASDAQ composite because that goes back a little bit further. So that was created in the early 1970s. So if you go back to then, actually August was the best month for that index of a gain, averaging around 3.2%. So, but usually it's tricky with election years. It's more dependent on if you know who potentially could be the winner or not. We still have a lot of question marks going into November.
And before I let you go, you also had a great piece out yesterday that talked about just the flows that we've seen since July 11th when we got that CPI report. The numbers were pretty staggering.
Exactly. So nearly $6 billion has flowed into non-tech U.S. ETFs. This is coming from Bloomberg Intelligence. So I had Athanathio Serafagis over at BI, one of your buddies, Paul, pull the data for me. So financials, industrials, utilities, healthcare, real estate, obviously that would benefit from rate cuts. Those are the ones flowing into it. And then if you look at technology for those ETF flows, just about $1.4 billion since that CPI report on July 11th, Alex.
All righty. Thank you so much, Jess. Really appreciate Jess Menton joining us, Bloomberg News, one of the best. Some breaking news for you here. Ukraine gets its first delivery of F-16 fighter jets from NATO allies. This is a long-awaited move that could boost the war-torn nation's ability to repel Russian attacks. The deadline for the transfer of the U.S.-made warplanes was the end of this month, and it has been met, and this is according to people familiar with the matter. The number of jets, though, is small.
As important, how about pilots? Are their pilots been trained? Are the pilots to fly these jets?
Well, I don't think we know that. It's not clear if they have that.
I think we've been training them, but I'm not sure if they're ready, so we'll see how that goes. But it's a morale booster, and you know, if you're a Russian, you probably don't want to see an F-16 screaming over your head.
Yeah, and President Biden had dropped his opposition to sending those F-16s to Ukraine in May of 2023. So now NATO allies have allowed that transfer to happen. Okay, let's get back to the market, shall we?
Let's get back to ETFs.
Ooh.
Talk about a growth business. Jennifer Grancio joins us here. She's Global Head of Distribution for TCW. That's Trust Company of the West. Los Angeles based, used to be a huge client of mine. They loved me. She joins us here in our Bloomberg Interactive Brokers studio. Jennifer, I mean, the money just keeps flowing to you guys, and it's just unbelievable how your market is growing, the ETF market. Where's some of the money going now? Are folks looking for income? Are they looking for special situations? What are they looking for these days?
Yeah, from a TCW perspective, people know us for fixed income, and so we have a developed set of equity ETFs now, but we launched the first fixed income ETF recently.
Okay.
And the ticker, because that's what we do in ETFs, is Flexor, FLXR. But Flexor and strategies like it are giving you return in the fixed income portfolio, but they're also giving you very consistent income. And if you think about how to actually construct a portfolio, equities can be volatile, money market funds and rates, they will go down eventually. And so we see a lot of investors looking for products that are giving you return, but they're also giving you this consistent income.
This might be a really silly question. Are these actively managed ETFs, or are these boring? Not boring. I mean, just passive ETFs.
We at TCW, we have one index ETF, and everything else we do is active. So our view on portfolios right now is there's a lot of uncertainty in the market, and particularly when it comes to fixed income and bonds, we think active management is the way to go. We can make a lot of choices about how to both manage your risk and optimize return, and in the case of a product like flexible income, optimize income at the same time. So we think active is the way to go in the current market.
And what's interesting about your MetWest Flexible Income, it was a mutual fund. So you converted a mutual fund into an ETF. Why do that?
Advisors like to invest in portfolio managers that have a long track record. They want to know that the team's been around and together and been making these choices on risk and return for a very long time. So at TCW, we have an excellent fixed income team. They've managed this particular strategy for 6 years with very high performance versus peers. And so in this case, it's logical for us to take that great track record and simply flip it into an ETF vehicle.
This might be also a silly question, but if the Fed starts cutting rates, does the appeal of an actively managed fixed income ETF become less? Because we're no longer going to be at 5% like money market fund rates, for example.
Well, I think we're not going to be at zero either. And so the way that we would think about it is if you're moving through time for years ahead of us, there really is an opportunity to be active, to drive return in the fixed income part of the portfolio. And frankly, from an income perspective, people need to keep up with inflation. So inflation's down somewhat. But from a price perspective, particularly aging population, if everyone's living till 90 or 100 years old, there are a lot of portfolios where the regular, repeatable income, in the case of flexible income, it's, say, 7% yield. So as money markets go down, we're actively able to manage to a higher income target.
All right, you guys in the ETF business, I understood the passive ETFs. I got that whole story and the cost. Then you guys brought in active ETFs. I'm like, well, wait a minute. I think active, I think managers, analysts, overhead costs. So is an actively managed ETF cheaper than a mutual fund?
In some cases they will be. In some cases, maybe they won't be. So in this case, with flexible income, we actually brought the cost down because we see the demand from an ETF perspective, and we think the fund is going to grow. And so we were able to take an active product that is a 40 basis point fee, but that 40 basis point fee is actually lower than when we were managing it in a mutual fund, and that brings real value to clients.
How about to you guys?
Well, for us, it's we're building a business, and we think that there's real demand for products like the one that we're talking about today. And so as that product grows, it's a great business for us to be able to serve clients with a product that can really scale and grow in assets under management.
Now, Jennifer, before you were at TCW, you were the CEO of Engine Number One. TCW acquired that part of the firm's business back in October of 2023. I'm an oil nerd, so I think Engine Number One, and I'm thinking, oh, the really successful shareholder push on Exxon to get 3 members on their board to really push for climate change. Can you walk me through all of that?
Yeah, so from an Engine Number One perspective, we saw an opportunity in the market where people were investing in energy transition or transformation, either not investing and holding index funds or investing in private equity. So a lot of what we did at Engine Number One was build a public market products. Exxon was a big part of that, still a big holding in one of the funds that came over to TCW, which is another ETF, NetZ. And the idea there is that we are going through an energy transition over many decades to come. And so in the case of working with Exxon, helping Exxon realize they could optimize their business and capital allocation to not waste money in the out years, but take advantage of what was happening in the next 10 years. And that work has added a lot of value to everybody that has held Exxon over this period. And at TCW, we still manage this Energy Systems Transition Fund.
So to that point, I mean, that was also when energy transition and green and climate, the pendulum was swinging very much one way, and the pendulum is swinging back the other way. Are you guys noticing anything now at TCW on that?
Well, we're at TCW, we're probably one of the leaders in looking at companies from an underlying risk and reward perspective across climate and governance, for example. And so we're a leader in that. That's a big part of our business in Europe. In the US, people may not want to buy products that are value screened, but we still do the work, so that we're doing the work so that if there's a company that's mispriced based on a climate risk or mistakes on the governance side, we understand that, and that's information that goes up to our fundamental portfolio managers. And it's just another way we're adding alpha for clients.
Interesting. So where from the ETF business for TCW, what's next for you guys? Where's the area of focus? Is it continued on the fixed income front?
It is for sure continuing on the fixed income front. So we have a set of equity products. We'll build to that over time. Excuse me. But on the fixed income side, we've got flexible income out in the market now, and we've filed for another 4 to 5 products that may be out as soon as the end of the year, because what we see is people want the best solution in fixed income portfolio construction. And so what we do as active managers, whether it's in the CLO market, secured bank loans, high yield, we think we can deliver, very attractive and more competitive than other people are out there today, return and risk profiles. And so we look forward to launching those ETFs shortly.
Can I go back to climate for a second?
Go.
Will Paul hate me here? You mentioned that you are helping to judge climate risk and you pass it on to the managers. How do you judge climate risk for a company?
It's different for every company.
I know.
And so,
how do you do it?
Yeah, I mean, so the way we do it is look at each company at an underlying data level. So if a company is in the energy sector, what are they doing about capital allocation in old, world energy? What are they doing to improve or green up in other areas? So we're looking at that. And then across most large companies, we're looking at water use, electrification, the goals that they're setting, and then measuring the progress that they're making against those goals. So we don't look at it in a carbon footprint only. We look at it as a sort of transformation, transition. How are they planning? How will they beat their competitors effectively in doing a better job as we move through time and we move through the transition?
So cool.
I don't know how you invest in energy companies, because do I want my companies going green now or just waiting?
Well, that's part of the problem, is that if you're a big energy company, or if you're an investor, you really only want to own one, because you can't own a bunch for that exact reason. And you can't go to shareholders or your investors and say, hey, I have a boatload of energy companies. So then that begs the question, how do you choose, which means bigger is better, and then hence Forth and Exxon, Chevron kind of thing. That's what I keep hearing. Chevron, Exxon earnings out Friday, so very exciting. This was great. Jennifer, thank you so much. It was wonderful to meet you. I'm a big fan of Katie Koch also, who's the CEO of TCW, so it's great to get you in the studio. Come back anytime. Jennifer Grancio, Global Head of Distribution over at TCW, normally based in LA, so we're very lucky to have her here. Coming up on the program, we're going to continue with the earnings theme. So Trane Technologies is basically an HVAC company. It's a really nice early cycle read on what's happening either in residential markets or in the commercial markets, in the office space. They had earnings that were pretty solid. We're going to talk to the CEO, Dave Regnery, coming up. Trane Technologies CEO joining us on that. Broader check-in here on the markets. You have the S&P holding up by about 1.4%, 1.6%, I should say, up about 89 points. Dow Jones Industrial Average up by about 0.5%. The NASDAQ up by over 2%. So really reversing any kind of that sell-off. But we're going to get the Fed at 2.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:21 on Wall Street. We do check markets all day long here at Bloomberg Fed Wednesday. We've got Meta Platforms after the bell. Stocks are surging. The Dow, the S&P, NASDAQ 100 index, Russell 2000 as well, all moving higher. Got to begin with the NASDAQ 100 index. It is ripping higher by 2.9% right now. To put that in context, because that's what we do here at Bloomberg, we got the S&P up 1.7%, the Dow up 0.5%, and NASDAQ is up by 2.5%. Again, the Russell 2000 up by about 0.5%. Stocks staging a big rebound amid a rally in beaten down chip makers. Case in point, NVIDIA now up by 11.5%. And this morning, the latest economic data bolstered bets that the Fed will be signaling a rate cut in September. All of that coming down 2 o'clock Wall Street time. Yes, Jay Powell's news conference. You can catch it live at 2:30 Wall Street time here on Bloomberg Radio. We've got the 10-year 4.10%, the 2-year 4.35%. Spot gold up $10 the ounce, up 0.4%. And West Texas Intermediate crude looking at a rally there, up 3.1%, 77.02 a barrel. And Brent, the global benchmark, back above 80, $80.60, up by 2.5%. Speaking of those chip stocks, after earnings, Advanced Micro Devices up now by 5.5%. Among some of the other names, Intel up by 1.7%. And then reporting after the close of trading today, we will be hearing from Meta Platforms up by about 2.3%. And briefly, KKR posting a second quarter profit that beat Wall Street estimates as the buyout firm generated more income than expected from selling assets. KKR up by 3.6%. So again, recapping here, rebound the theme today, S&P up by 1.6%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Charlie Pell, thank you so much. We appreciate it. You're listening to Bloomberg Intelligence. Alex Steele and Paul Sweeney live here in our Bloomberg Interactive Broker studio. All right, here's a company for you. I had not heard about it until recently. Trane Technologies. I believe they're based in Ireland, but they are a global climate innovator focused on sustainable solutions for buildings, homes, and transportation. Carolyn Ubelhart from Bloomberg Intelligence, she covers this stock, and she's a grizzled veteran. She is not given to praise companies unnotably. She says they had a great quarter again, amazing company in a very attractive sector. So when she told me that, I said we got to get these guys on Bloomberg and get our talk about, see what's going on with this company. Dave Regnery joins us. He is the CEO of Trane Technologies. The ticker is TT on your Bloomberg terminal. Stock hit a 52-week, and actually I'm going to call it an all-time high today on the back of some pretty good numbers, earnings and sales beat on consensus. Dave, thanks so much for joining us here in lovely Davidson, North Carolina. Talk to us about your company. What's driving the performance of Trane Technologies these days?
Well, first, Paul, thanks for having me on the show. I just got off our earnings call, and we reported a very strong second quarter, much like we did in the first quarter. Our organic revenue growth was up 13%. Our order rates were up 19%, and our EPS growth was up 23%. So very proud of what we've been able to, how we've been able to perform. Look, as far as what's driving our growth, I always tell people we have a system of things that makes Trane Technologies a great company. And whether it's the way we operate our facilities through our business operating system, whether it's the way we innovate our new products, or whether it's our direct sales force, those are a system of things that make us a great company. And we have a service business that's a third of our company that's performing extremely well. In the second quarter, our service business was up mid-teens from a growth perspective, and we have a culture that's we believe in challenging what's possible and innovating for a sustainable world.
So based on that, it's great to chat with you, by the way. I love talking to you because you have such a great read on the residential and commercial businesses. Basically, you have a commercial HVAC unit and a near-term residential HVAC unit. And of course, that's heating, ventilation, air, and cooling. Where's the strength? Where's the growth? Where are the weak points?
Yeah, I'll start with residential. We had a very strong quarter in the second quarter. Our revenue was up mid-teens. Low teens. But our residential business for the prior, I'll say, 3 quarters had really been struggling with a refrigerant change that wasn't clear. That's been clarified. It was really struggling with excess inventory, kind of a hangover from the COVID days that was in the channel. Those both corrected, and we're off to a very warm start to the cooling season, which should have us all concerned for a different reason as the climate continues to increase in temperature. But I would tell you that it's a very strong start to the year. So very strong in residential. Our commercial business, really broad-based growth. Certainly the high growth verticals like data centers, we do very, very well in, or education, or in healthcare. But we had broad-based growth. In the Americas, we track 14 different verticals, and we were hard-pressed to find a vertical that we were not strong in. So it was a very strong quarter for Trane Technologies. I'm very proud of what the team's been able to accomplish.
Yeah, I'm reading the Bloomberg Intelligence research note out on your earnings. North America's 16% organic growth was much greater than the 10% consensus. What drove that?
Yeah, really two things. Our residential business performed better. Okay, we thought that was going to be, in the beginning of the year, we thought our residential business would be low single digits. We came in, low teens in the quarter, so we significantly outdrove that. And then our commercial HVAC business just continues to operate at a very high level. And like I said, services was up in the high teens actually in the Americas, and their equipment business just continues to exceed our customers' expectations. So very strong quarter. I was listening to your show earlier. You were talking about sustainability, and I would tell you that at Trane Technologies, our purpose is built around sustainability. And what people are talking about right now is you're hearing a lot about how much power is going to have to be generated to meet the demand that's coming, and you'll hear a lot about data centers using a lot of the electricity. What nobody is talking about is the amount of power that's being generated that's being wasted. And I would tell you, we call it demand side management. And we know, because we've done hundreds of thousands of energy audits in buildings, that most buildings operate about 30% inefficiently. So just think if we could solve that problem. And if we can make buildings perform the way they were designed, or assets perform the way they're designed, just think about the amount that we could save in the energy that's being produced, and which obviously has a trickle effect to the carbon footprint. So that's what Trane Technologies is all about. People always ask me, where do you see the growth coming from? It's going to be on the demand side management side.
Hey, Dave, we really appreciate it. Definitely come back. I know you got to run, but we appreciate your time today. When you're in the city, come in and tell us more about it, and I'm also curious as to those customers. Are they willing to pay up for it? We got lots more to talk about. Trane Technologies up by about 3.5% today. That was Dave Regnery, Trane Technologies CEO and HVAC company, joining us there. Okay, let's get to other areas of the market. What are we doing here? We're going to do Meta.
Mandeep Singh.
Is it Meta?
It's Facebook to me. Now, you guys can call it whatever you want, but when I take a company public...
yeah, fair enough.
Yeah.
Well, you have a special tie.
I have a special tie, but Mandeep, he's got a special tie because he does this stuff for a living. Mandeep Singh joins us here in our studio, Bloomberg Intelligence Senior Technology Analyst. We'll get to Meta first. What happened to Lyft in New York City? Can you explain that? Because we talked about that news story today, and I didn't really understand it.
Well, so they talk about, kind of raising the fares for the drivers. And the same thing happened, in California with the Prop 22. So this thing keeps coming back again and again in terms of how drivers get compensated and what these companies...
so the city of New York wanted to raise... Okay.
Yeah.
And so what did they decide today?
Well, they don't have to.
Okay.
And so the companies, again, similar to Prop 22, this is, again, in their favor.
Yeah, but this is not Meta.
This Uber
so
story.
To be clear.
He's my Uber guy, so and my Lyft guy. So I saw that news story, and I just, because we all love Uber and Lyft. So, but again, are they employees or not? So, all right, that's that.
That's that. Okay. Check.
We confused everybody there. Meta preview.
Well, a lot to look forward to, simply because when it comes to generative AI, everyone is focused on the ROI. Mm-hmm. And we saw with Microsoft, they talked about, $1.3 billion in AI revenue. In the case of Meta, it will be all in their digital ad impressions and ad pricing. There is no separate Gen AI contribution that they're going to call out. And so that's where it gets interesting, because they have the most NVIDIA GPUs. Think about it. Microsoft called out supply constraint being an issue. Otherwise, they would have printed a higher growth number for their Azure business. So everyone is supply constrained when it comes to these GPUs. Meta has the most GPUs, and it doesn't have an external cloud-facing business. They all consume it internally for their family of apps, whether it's Instagram, WhatsApp, or Facebook.
Is that to create a better advertising solution?
Both better advertising solution as well as a better recommendation system for you to watch the videos, the reels that you consume on Instagram, just the overall app experience.
Okay, so they have the most GPUs, but they don't have the cloud-facing business. But don't they have Llama? Like, is Llama a thing that they're going to make money off of?
And they have open source it. So they don't make any money off it. In fact, they're the only ones who have open sourced it, and they want the community to use it for free. So clearly their strategy is very different from the cloud hyperscalers who are monetizing through the cloud platform, the co-pilots. Meta is like, we just want to drive engagement, and we'll give you the best tools to the advertisers for them to create these ad campaigns using generative AI. Very different strategy. It'll be interesting to see how the street responds when they say our CapEx is going up 20%, which I expect tonight.
All right, so among the big digital ad players, Amazon, Google, Facebook, how's Meta doing in that whole thing?
Actually, Amazon is quite interesting because if you think about their run rate, $50 billion ads business growing at 25%. And when Pinterest missed last night, they had, you know, a sort of a downbeat quarter in terms of guidance. That tells me Amazon is having a real impact on companies, the smaller ones like Snap and Pinterest. YouTube also had a light quarter. So clearly, Amazon and Meta are going to be very interesting. I mean, Meta reports tonight, Amazon tomorrow, but I think Amazon is taking share here because of how well they are doing on the e-commerce side.
Going back to Meta though for a sec, why are they doing it in this direction? Like, why are they basically making this AI stuff to make my experience better and then to help sell ads? Like, why are they doing it this way?
Because they never had a cloud business. And remember how they made the pivot to AI. They're still big on metaverse, reality labs, that whole thing. And it's losing.
We still do the metaverse? We still into that?
They're losing $18 billion a year. So that's a sticking point with the street is if they raise CapEx by 20% without any offset on the reality lab side, you have to ask yourself as an investor, are you really going to be that patient with Meta, given what we have seen, you know, 3 years back with them spending on metaverse? And I think that's where I expect a more negative reaction to Meta raising CapEx than we saw with Microsoft.
All right, I'll catch the conference call from the beach.
Okay, that's fair enough.
Is that all right? It's fair enough?
I'll still be on TV, so you know,
okay.
that's why I'm taking all the notes.
And Mandeep and his minions will be writing up the research note, and I'll be on the beach. That's how it should be, folks. I've earned that. Mandeep Singh, thank you so much for joining us. You are a go-to guy on all that technology stuff, including the ride-sharing thing. Mandeep Singh, Senior Technology Analyst for Bloomberg Intelligence, coming into the Bloomberg Interactive Broker Studio. He's not mailing in from some resort. He comes into the office like a professional should. We note that.
Said the guy who's going to take the call from the beach.
Yes, exactly. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:40 on Wall Street. We do check markets all day long here at Bloomberg. We have got stocks advancing, S&P holding very close to the best level of the morning. Right now up 91 points. That is a gain of 1.7%. Stocks staging a rebound, and amid a rally and beaten down chip makers with the latest economic data bolstering bets that the Fed will signal a rate cut in September. All of this comes down 2 o'clock Wall Street time. You will have the decision as it drops on Bloomberg Radio and Television. And, of course, Jay Powell's news conference, 2:30 p.m. Wall Street time, and analysis as you have come to expect over the years. S&P right now up 92, gain of 1.7%. The Dow is higher now by 225 points, up 0.5%, but certainly the outperformer. The NASDAQ 100 index up 2.8%. NASDAQ right now up 437 points, up by 2.5%. 10-year yield 4.10%. The 2-year 4.35%. Gold up 0.5%, 24.22 the ounce, and West Texas Intermediate crude 77.35 a barrel, up now by about 3.5%. Fresh data on America's labor market in the build-up to Friday's monthly jobs report. What a week this is, and with more, here's Bloomberg's Vinny Del Giudice.
Business hiring slowed in July based on data from payroll processor ADP. We're looking at a gain of 122,000 jobs, the smallest increase since the start of the year. Wage growth also slowed, ADP says. Another report from the Labor Department shows employment costs moderated during the second quarter. That data tracked wages and benefits. Vinny Del Giudice, Bloomberg Radio.
After earnings, Microsoft shares down 1.4%. After earnings, Starbucks up 4.5%. And of course, after the bell today, we will be hearing from Meta Platforms. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie Pell, thank you so much. We appreciate that. Alex Steele and Paul Sweeney live here in our Bloomberg Interactive Brokers studio, streaming live on YouTube as well. So you can head over to youtube.com, search Bloomberg Podcast, and that's where you'll find us. Well, it is Fed Day. We will hear from the Fed at 2 o'clock. Press conference at 2:30. Bloomberg's coverage begins at 1:30. Tom Keene, Lisa Abramowitz, John Farrell will bring it to you. Jeffrey Cleveland joins us here. He's the chief economist at Payden and Regal, joining us via LA via that Zoom technology thing. Jeff, what do you expect from the Federal Reserve today? A lot of folks are saying pay attention to maybe the tone as it relates to September. What are you looking for?
Well, Paul, happy Fed Day. Beautiful day here in Los Angeles.
So excited, this guy.
I know.
Yeah, I think this is a great day for the Fed to set up for a potential cut in September. They don't need to rush into anything, though. I don't think there's an urgent need to rush rates. We saw to cut rates. We saw very strong second quarter growth. I think the labor market is still doing pretty well, so there's no urgent need. But you know, if inflation continues to cool, like we saw in the PCE data for the month of June, then it's possible by September we will get a rate cut. So I think, you know, setting up that possibility, keeping their options open, and then maybe pushing back a little bit on market expectations. If you earlier this week, I looked through the end of next year, so the end of 2025, and there were around 7 cuts priced in. So to me, that's more than a fine-tuning operation. That would be, you know, more of a rates, I would call slashing operation. So maybe pushing back against the longer-term pricing.
Well, to that point, I mean, the 2-year yield is down 40 basis points for this month. A huge move, and I'm betting that a lot of that happened after July 11th was when we got that CPI number. So if Jay Powell sort of becomes a little bit more balanced or tries to have a message that's more balanced here, what's going to happen to the front end of the bond market?
You know, we think we're in a soft landing, and that, you know, that's sort of the scenario we're in. We'll be in the soft landing over the next 6 to 12 months or so. So in that environment, I think moderately lower Treasury yields make sense. 2-year yields, 5-year yields, 7/10s, what have you. So that makes sense. On the short-term basis, though, I think the market is far too confident over the September cut. You know, you can be in a soft landing and cuts arrive later. So probably in the short term, in your scenario where, you know, Chair Powell pushes back a little bit, we will see some upward pressure on 2-year yields. Another candidate for maybe some upward pressure would be Friday's jobs report. We get a decent jobs number, but also, you know, we've been watching the last few months the unemployment rate creep up. It's possible the unemployment rate will tick down this Friday, and that'll pour some cold water on these sort of bearish calls about the Fed. It needs to do something now. The economy is weakening, and that could have impact on 2-year Treasury yields.
And Jeffrey, Alex and I had one of those discussions earlier today with Danielle DiMartino Booth, who feels like this U.S. economy is already in a recession if you really take a look at the real-time data, and that the Fed they're actually behind the curve. They should have already been cutting. How do you respond to that when you hear that amongst investors?
Q2 GDP grew 2.8% quarter-to-quarter annualized. On a year-on-year basis, it was up 3%. The consumer continues to be solid. The unemployment rate has creeped up. It's still low. That's 4%. That's very low historically. Initial claims for unemployment insurance layoffs, pretty good reliable indicator of whether we're in a recession or not. Very low still. So I don't know. And I've been hearing this story for probably 8 quarters now. I think since 2022, people said, if the Fed starts hiking, they're going to pull the rug out of the economy, out from under the economy, Paul. It just hasn't happened, right? Yep. The economy keeps going.
Well, but here's the problem, right? Is that it's a K-shaped economy where the lower and middle income houses are getting continually squeezed, and the upper income are enjoying 5% on their treasury bills. So with that, I know that that's nothing unusual necessarily within the economy, but does that put a little bit more pressure then on the Fed?
Well, I think if you're the Fed, you are looking at inflation. It has moderated, especially in the last 2 months, similar to what we saw maybe in the second half of last year. If that continues, you could very easily, Alex, be back to 2.2, 2.3% year-on-year core PCE sometime next summer, which is close to target. So that's good. At the same time, the unemployment rate has crept up. So they don't want to just be restrictive, stick at 550 for the foreseeable future. So they are aware of that. And, I think that's a good argument for fine-tuning the Fed funds rate. You don't need to be at 550 if inflation's at 2.3 and the unemployment rate's creeping up. Now, do you need to slash back to 2.5% or 3%? Probably not either. It's more of a fine-tuning operation. I might have mentioned it on this show before, but, like the mid to late 90s is more of the historical analog, if you will, for what I sort of envision. The Fed did cut a few times in there, but growth continued throughout that period. Stocks did well, bonds did well, so it was a good environment.
So overall, in terms of the consumer, how do you feel like the consumer is faring out there?
I think, for me, job growth continues. You have more people working. They're still earning wages, although wages have, cooled off a little bit to about 4% year on year, what we're seeing in the ECI data. It's inconsistent what we've been seeing in average hourly earnings. But it's really income growth that drives the consumer and consumer spending. And that is still holding up through the latest set of data. We'll get an update on that on Friday. But I think that's really key. Separate from that, Paul, you can think about household net worth still looks pretty good. We still think households have savings. If you look at household debt service as a share of their disposable income, those ratios are still quite low, even though rates have crept up. So all in all, I think the consumer is in decent shape still.
All right, let's pretend. Oh, no.
No, sorry, go ahead.
I was going to say, before we let you go, what would be the question you'd ask Jay Powell if you're in the presser?
Well, I would ask him, hey, what do you think about the unemployment rate rise? We've gone from 3.4% last spring. We're now 4.1. How concerning is that to you? How much is that weighing on you in terms of the decisions you will make? I might also ask him, hey, the market thinks you're definitely cutting in September. What is the one thing that would really change your view? I think it would be core PCE, coming in month to month hotter in the next couple of months, choppy inflation, but I think that's a worthwhile ask.
All right, thanks so much. We really appreciate it. And I would love it if you went into a press room and was like, hey, Jay, tell me about this. All right, Jeffrey Cleveland, chief economist over at Opinion Regal. Super appreciate that. All right, coming up, it was a headline that made me gasp, and then nothing seemed to happen. And it was a new CEO over at Boeing appointing Kelly Ortberg as its next chief executive officer. The stock is up over 3%. But Paul and I both are really excited and want to know what this actually means. He looks to be an operator, so that's exactly what they need. So we're going to break that down with George Ferguson, Bloomberg Intelligence Senior Aerospace, Defense, and Airlines Analyst. He's going to be joining us on Boeing just after the break. All right, we're looking at the Dow Jones Industrial Average up by about 0.5%. The S&P up by 1.7%, and the NASDAQ up by over 2.5%. This is Bloomberg.
your company news headlines on Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pellet. Boeing has appointed Kelly Ortberg as its next CEO, entrusting a retired veteran of the aviation industry with one of the most complex turnaround challenges in corporate America. The plane maker made the announcement as it reported a steep loss in the second quarter. We'll have more on Ortberg and his challenges coming up with our George Ferguson of Bloomberg Intelligence. Boeing shares, they are flying higher right now, up by about 3.5%. Delta Airlines says it expects a $500 million impact from the technology breakdown this month that led the carrier to cancel thousands of flights. Shares of Delta Airlines right now are trading higher. We've got Delta up by roughly 0.7%. Microsoft down by about 1.5% after the software giant reported a slowdown in growth for its Azure cloud business. Bloomberg Intelligence senior tech analyst Mandeep Singh says investors may have been looking for more.
The fact that they came at the low end of the Azure guide at 30%, whereas Street was expecting 31%. You can always nitpick such things when a stock is trading at, 35 times PE, but clearly they had a lot of positives in their print, especially on the AI side. They did not skip a beat, and they are raising their capex, which to my mind is a sign that they continue to expect these businesses to ramp up nicely next year.
Mandeep Singh of Bloomberg Intelligence. And on an update for the rest of the market, on an update for a lot of big tech names, we've got Microsoft down now by about 1.5%. We're also keeping an eye on Advanced Micro Devices, AMD surging 4.7% after the chipmaker delivered an upbeat revenue forecast. Those are some of the top company stories that we're following for you at this hour. I'm Charlie Pellet, and this is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Wednesday, everyone. I'm Alex Steele alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance through our lens of our Bloomberg Intelligence analysts. They cover 2,000 companies and 130 industries worldwide. And one of them that I bug all the time is George Ferguson, Bloomberg Intelligence Senior Aerospace, Defense, and Airlines Analyst. I stalked him yesterday over Airbus because we had the CEO on TV, and I was like, George, I need more questions than just, hey, what's up with space? What's up with Boeing is now the better question for today. So Boeing now appointing Kelly Ortberg as its new chief executive officer. The stock is up by about 3.5%. He is a retired veteran of the aviation industry. He is an engineer by training. Is this the guy that Boeing needs? George, is he?
Not so sure. I think it's the guy that Boeing needs for a small period of time, right? Because he was already retired, right? He has he's a great career in aerospace, working at Collins, helping put Collins into RTX. I mean, great experience. He's 64. So my guess is he doesn't have a lot of runway to work at Boeing. I think it would have been nicer to see a CEO that could have put, 5, 7, 10 years into Boeing. But look, I think the job is very difficult. And so I think it's going to take a lot out of the next CEO. And so maybe this is an interim as they continue to develop internal candidates for the job. Maybe it's pretty difficult to recruit somebody into this job right now. So could be an interim because of that as well. So again, the strong aerospace background at the component, at the, parts maker level, but doesn't look like someone's going to be around for the next 5, 7 years.
All right, George. All right, so that's the CEO. How about on the fundamentals here? I'm looking at the second quarter. Negative adjusted free cash flow, $4.3 billion. You can't
good.
like that. Talk to us about kind of the cash flow, the dynamics, and what they need to do.
So we kind of expected that $4.3 billion. To be really honest, not totally sure why the stock is up. I don't think it's Kelly, because Kelly news started the day out, and Boeing, I think, was up about 1. So post-earnings were up. We've done this pop. We heard from CFO Brian West during the call. He told us burn was going to be pretty strong in 3Q2. And then the analysts tried to box him in on what burn was going to be for the year. One said would be closer to 5 billion or 10 billion. He said he wasn't. I think his quote was something like, I'm not smart enough to tell you at this time. So there's just a lot of variability right now. Look, Boeing has to keep taking inventory, taking ship sets from their supplier base to keep their supplier base in business while they ramp up builds. And they had some good commentaries and builds. They talked about the factory kind of putting out 20-ish, I think was the number. And I think total deliveries in the 30-ish range for 737s, rising to 38, shutting down those shadow factories. It's the factories that they have the inventoried airplanes, a lot of 737s, some 787s in, shutting them down by the end of the year. That was, I think, great commentary. You know, we got to the commentary about what's going to go on with the union negotiations. Those are coming up in September. Dave Calhoun kind of told us he, I think, wasn't totally focused on that right now, or couldn't give us puts and takes there. That's incredibly important, right? So if we get into a situation where the union shuts this company down in September, the cash burn this year looks horrible. They're back going to capital markets, looking for a bond raise, which I think everybody on the bond side is scared to death about because they don't want to see a fall to investment grade, or they're going to the equity side, which the equity guys don't want to hear about, right? Because that's dilution. You know, so I think, again, commentary was good around deliveries and things like that, but a lot of variability coming, you know, here around this cash flow burn, and it's super important.
All right, George, thanks so much for joining us. We appreciate it. As always, George Ferguson, Senior Aerospace, Defense, and Airlines Analyst, Bloomberg Intelligence from Princeton, New Jersey. Boeing, weak results in line with expectations, but they got themselves a new CEO, so maybe he can turn this thing around. Coming up, Balance of Power with Joe Matthew from Washington, D.C. Lots to talk about there coming out of D.C. That's coming up right now.
From the world of politics to the world of business, this is Balance of Power. Washington, D.C.
Kamala Harris ties up the race with Donald Trump. Welcome to the fastest show in politics. As the vice president closes the gap in the 7 swing states tracked by Bloomberg and Morning Consult. We'll get the numbers ahead from Eli Oakley at Morning Consult with analysis today from our panel. Republican strategist Lauren Tomlinson is with us alongside Democratic strategist Janae Wartell. The political leader of Hamas is killed in an Israeli airstrike in Iran. We'll have more on this escalation with Holly Dagris at the Atlantic Council, what it means for a possible wider conflict in the Middle East. And we'll get ready for today's Fed announcement with Stuart Paul from Bloomberg Economics. And that is exactly where we start today with Charlie Pellet, who's got his eyes on Wall Street for us. An update on the markets right now from New York. Charlie, what do we have?
What we have is a lot of moving parts, Joe Matthew, and those parts include a lot of earnings, a lot of economic data, and yes, the Fed meeting, the big event coming up, 2 o'clock Wall Street time. The clock is ticking. We'll have that for you live as the decision drops on Bloomberg Radio and Television. And of course, Jay Powell's all-important news conference at 2:30 Wall Street time. Just under 2 hours to go right now. We've got stocks staging a powerful rebound amid a rally in beaten down chip makers. Case in point, NVIDIA ripping higher now by 11.7%. NASDAQ is up 429 points, up 2.5%. The NASDAQ 100 index full of big tech names surging 2.8%. To put it all in context, we got the S&P up 1.7%. The Dow right now up by 0.6%. The Dow rallying by 255 points. So a lot of green. 10-year yield 4.09%. The 2-year 4.35%. Gold up 0.5%. 24.22 the ounce. And a big rebound for crude oil today. We've got West Texas Intermediate up 3.6%. 77.41 a barrel. Brent crude, the global benchmark, back above $80 a barrel. Brent right now up by 2.6%. So just under 2 hours to go. Wall Street betting the Federal Reserve will signal a rate cut in September. Leslie Falconio is head of taxable fixed income strategy at UBS Financial Services.
We don't see in the data, and we do believe in a soft landing, we don't see in the data any reason why there should be any type of emergency cuts, particularly after what we saw at GDP, after retail sales, or there needs to be a 50 basis point cut right now.
Leslie Falconio of UBS Financial Services. Earnings news on an update for tech, on an update for much of the market. Microsoft down now by 1.7%, also slumping after earnings. We've got Marriott International down now by 6%. Recapping Fed Wednesday, lots going on. S&P up by 88, gain there of 1.6%. Back we go to Washington once again. Balance of Power continues with Joe Matthew.
All right, Charlie Pellet, thank you. There's your baseline on this Fed day. As Charlie said, 2 hours from right now, we'll get an announcement from the Federal Reserve. Our special coverage of the Fed meeting will start at 1:30 p.m. New York time, Wall Street time today, with the S&P 500 up over 1.5%, 2.5% gain on the NASDAQ. This better be good, as we still hear those outliers. I heard a couple of them coming in this morning thinking we might get a surprise cut today. But that's not how the Fed works, right? We've got a lot to talk about this hour. Thank you for joining us on the Wednesday edition of Balance of Power here on Bloomberg Radio, on the satellite, and on YouTube, where you can find us right now by searching Bloomberg Global News. Search Bloomberg Business News Live. Do what you need to do. It's still right there from the last time you searched. You'll find our live feed, and we'll save a seat for you here in the studio. A lot to talk about when it comes to politics. Our new Bloomberg News Morning Consult swing state poll is out, putting numbers on the honeymoon for Kamala Harris. Fresh off the big rally in Atlanta. We'll talk about that, as I mentioned, with Eli Oakley at Morning Consult. This is the first comprehensive swing state poll since Joe Biden dropped out of the race. You're going to want to hear about this with not only the top line numbers, but where voters see Trump and Harris on the issues, including the economy, things like interest rates. What we're going to be talking about right now is Stuart Paul, the economist, chief U.S. economist at Bloomberg Economics. Stuart, it's great to see you. Thanks for joining live from New York. You're not allowing for a surprise today. Of course, I guess it wouldn't be a surprise if you were. But the Fed needs to telegraph every move here in advance, right?
That's right. So we're not expecting any sort of a surprise cut. A full cut is basically priced in for September. So we're expecting the Fed to show its hand a little bit more in today's meeting. The Fed could come out and be very bold in the FOMC statement, adding a sentence like, if the data evolve as the committee expects, it may be soon appropriate to cut rates. But we think that it's really going to be a matter of detail. So, for example, in the opening paragraph of the FOMC statement, it says that in recent months, there has been modest further progress to the Fed's 2% inflation target. If the committee just removes the word modest and just says there has been further progress toward the inflation target, it would be indicative that the balance of risks is shifting. The Fed doesn't have to keep its foot on the brakes as much to rein in inflation, and that unemployment is starting to become a bit more of a priority for the Fed.
Yeah, that's a great primer. So a very slight tweak in language could mean a lot, I think, is what you're saying, Stuart, and then that would be reinforced, I presume, by Jay Powell in the news conference.
That's right. So Powell does, I think, at least to my ear, come out a bit more dovish at the press conferences than the FOMC statement tends to be. So I do expect him to be a bit more clear in the FOMC press conference that a cut is definitely in play in September. And then there are still 6 weeks, and during those 6 weeks, we're going to have the famous Jackson Hole Conference, and that's always an opportunity for the Fed to really make clear their intentions. And of course, that comes before the September meeting, and that's when we think we're going to see the first cut at that September meeting.
You're talking on a politics show here, Stuart. There are a lot of questions about the role that politics may or may not play, or the perception, let's be honest, of politics. It's not like Joe Biden's on the phone, I'm assuming, with Jay Powell and Kamala Harris and Donald Trump. We could say the same about them, but there are concerns that there could be an appearance of, political interference if there's a rate move in September. Is the Fed flying above that? Is that just something you and I talk about?
The Fed at least outwardly likes to say that it's flying above the political fray. It likes to say that it's focusing on maintaining its political independence. It doesn't have any sort of a political filter when it's making decisions. But I will say this, that when there is a blowout in the polls, and when it looks as though, for example, Trump is leading Biden by several percentage points, it's easier for the Fed to say that. When it's a bit of a closer race, and as we're seeing in the Morning Consult poll, and I'm looking forward to hearing your conversation with Eli Oakley, but when it's a much closer race, especially in the swing states, it's a bit more difficult for the Fed to not get entangled in any sort of the political goings-on around the country. So it is going to be a topic of conversation. It is going to be a question that Powell is going to have to deal with at the press conference, especially now that it's a closer race in those swing states.
We'll find out in just a couple of hours in terms of today's meeting and the forecast for September. Stuart Paul, Bloomberg Economics U.S. economist. Great to see you, Stuart. Good luck at 2 o'clock.
Thank you.
When the building shakes and the Fed speaks. Of course, we'll be in the lockup down here. Michael McKee will join us a little bit later on in the day in the late edition of Balance of Power to talk about what happened. He's crafting questions right now for Jay Powell. Because it's, again, not just the statement. It's going to be the nuance in the news conference to Stuart Paul's point. That's where the message is going to be reinforced with reporters over at the Fed today. So, with that in mind, we turn to the aforementioned Bloomberg News Morning Consult Swing State Poll, in which voters in the swing states, the 7 swing states that will decide this election, were asked about things like interest rates. Who do you trust more to handle interest rates? Look at this. Donald Trump, 46%, Kamala Harris, 39%. Who do you trust more to handle the cost of everyday goods? Donald Trump, 47, Kamala Harris, 42. Taxes, Trump 47, Harris 42. But when you pull out from the economic issues and you look at the top line numbers, this has been a remarkable, if not seismic shift in American politics in just the better part of a week since Joe Biden dropped out. Kamala Harris rose to the top of the ticket. She is now in a statistical tie with Donald Trump. Pleasure to bring in Eli Yoakley. We do this every month when the big poll drops. U.S. politics analyst at Morning Consult, our partners on this poll. Eli, have you ever seen a turn like this? I'll get into the states, especially Michigan, with you in a second, but just overall, to erase a gap like that is pretty remarkable in just 7 or 8 days.
Have I ever saw it? I saw it this week. Let's go. What a time to be alive. But no, look, it's truly remarkable. Clearly, this is a reset moment in the campaign. I mean, we've been talking month after month. This is our, I think, 10th wave now. And the race was kind of static. And between Trump assassination, Joe Biden dropping out, and Kamala Harris's rise, it's been a pretty seismic few weeks. And I think the American electorate is paying attention now.
The American electorate is paying attention. And if the election were held today, pretty hard to say where this would go. But when we drill down on the states, we learn a lot. Eli, Pennsylvania remains Donald Trump's to lose, according to what I'm seeing here, 50% to Harris's 46. But she's closed the gap and is, in fact, leading Donald Trump in both Michigan and Wisconsin. This Michigan number jumps off the page, plus 11. Could we look back on this as an outlier? How do you explain that, Eli?
It's possible. I mean, all these figures could be outliers when we look back in a few months. What we're noticing, and I think Michigan is a good example of this, is the fact that Democrats and voters of color, young people, are starting to come in line to how you would typically expect them to perform. Kamala Harris is performing so much better among Biden's 2020 voters than he is. She's at parity with Donald Trump in the swing state aggregate. That had been his big advantage across the swing state map, was getting those folks who voted for him back in 2020 to say they're going to vote for him again. That advantage seems to have been erased. Now, look, not to pour cold water on anything here, but if we look at the leads that Kamala Harris has today and say she wins all of these, it doesn't make her president. Having Georgia tied, for example, could be the decisive state at some point. We'll have to watch what happens in the coming weeks. I mean, this happened just as her campaign launched. And so this is an early moment in the campaign to get a gauge of where voters are with her. But at this early stage, before the hits have come against her, she looks to be in a much better position at winning the White House than Joe Biden was.
Well, just to put a finer point on that, Eli, is Kamala Harris ahead now of where Joe Biden was before the debate?
She is, especially when you look at the national numbers. I mean, it was a pretty close race. We do daily tracking every single day, and we did not see much movement. Joe Biden was under Trump by 1 or 2 or 3 points, depending on the day. Every survey we've gotten back in the last few days since Kamala Harris became the presumptive nominee has had her up on Donald Trump. Clearly, that is a shift in the political environment in the Democratic Party's favor. And then after the debate, I mean, Joe Biden was just not in a position where he could be really competitive, probably, as the race stood. But, you know, now it's still early. The Democratic National Convention is going to be a big defining moment for Kamala Harris. I remember watching our tracking of the 2020 contest, and what Stephanie Cutter and the Democratic National Convention did for Joe Biden was boost his favorability and strengthen the kind of views people had of him. People don't pay as much attention to vice presidents as we do here in Washington. I mean, even Kamala Harris's numbers were pretty soft. A lot of people had somewhat favorable or somewhat unfavorable views of her. And we're starting to see that shift as she gets the spotlight. The coming weeks, as the Trump campaign rolls out some negative ads and she gets out her positive ones, plus the Democratic Convention is going to see how she's able to stand up to some of this scrutiny.
I know you asked voters, Eli, about some of the candidates on the short list for running mate. Is it worth talking about that? Each state's going to feel differently about their own favorite son or daughter. Did we learn anything that equals a trend?
I think that the numbers are pretty intuitive. If you're in Arizona, you like Mark Kelly. If you're in Pennsylvania, you like Josh Shapiro. On the national level, it kind of also makes sense. Pete Buttigieg is the most well-known and well-liked figure that has been on various short lists. He's followed by Josh Shapiro. And if you're thinking about Pennsylvania, you're thinking about a place where both Joe Biden and now Kamala Harris are not yet leading Donald Trump. You can see how a popular governor who can give quite a speech that makes a lot of people think about former President Barack Obama every once in a while. You can see that being a helpful person to have on the ticket. But what is going to have to happen with the vice presidential nominee is just a severe attack dog. I mean, the campaign via Morning Joe and other shows that the Democratic possible contenders have been waging has been pretty fascinating to watch. It's been which Democratic governor can out-attack Donald Trump and J.D. Vance. J.D. Vance has become a great target for some of these folks with some of the interesting developments we've learned about his history. But I think the vice presidential contender probably matters not as much as that top of the ticket figure, Kamala Harris, who really seems to be getting Democratic voters in line.
I'm sure it's not even close, to be honest, but you're right. Pennsylvania is not lost on us, and the fact that she has an announcement on a running mate, I believe, scheduled, or at least the first stop is going to be in Philadelphia next week to start this road trip with the running mate. I don't know, just something to consider. By the way, if you didn't see the video of Governor Shapiro playing basketball with those young kids yesterday, pretty strong optics. Eli, talk to me about motivation here. Activating the base. More than a third of voters in the 7 states here say they are much more likely to vote in a Trump-Harris contest than a Trump-Biden one. What does that tell us?
I think the most interesting figures there are the people most impacted. This have been Black voters. That's such a core key constituency for Democrats to be able to win elections. Having Black voters more fired up this time around is only a positive step. I think the most important thing, though, is these young voters. I mean, Gen Z is up there on the same level as Black voters in terms of new enthusiasm. I mean, that's one of the things that made the Michigan numbers stand out so much was Kamala Harris reversed the Democrats' poor performance among the youngest voters in the electorate. We saw that across the larger swing state map, too. Getting young people excited is how Democrats win presidential elections. It's one of the most important groups to get fired up to come out to the polls. And so I think a shift at the top of the ticket plus a more compelling figure for young people is going to do a lot of work to help motivate those voters and put Donald Trump on the defense for the first time in a while in this campaign.
Eli, really great to have you back. Eli Oakley, U.S. politics analyst at Morning Consult, our partners throughout this campaign on our monthly Bloomberg News Morning Consult Swing State Poll. Fascinating stuff, Eli. Thank you, as always, for the insights and the great analysis. The other question that we didn't have a chance to discuss had to do with violence, political violence. around the election. It's something that we've been asking voters about month to month. In this case, how did we ask it? How much do you trust the election and its aftermath will be free from violence? Only 16% said a lot. 34% said some. We'll keep tabs on that as we get our way through Chicago and get closer to November. I'm Joe Matthew in Washington. Thanks for coming along. The fastest show in politics. We'll turn our attention to Israel and Iran coming up next on Bloomberg Radio.
It's 12:21 on Wall Street. We do check markets all day long here at Bloomberg. A powerful rally underway on Wall Street. Fed Wednesday, stocks surging amid a rally in beaten down chip makers. Case in point, NVIDIA up now by 12%. The latest economic data bolstered bets that the Fed will be signaling a rate cut in September. That Fed decision, 2 o'clock Wall Street time. Jay Powell's news conference, 2:30 Wall Street time. Right to the numbers with the S&P up 89 now, up 1.6%. 0.5%. The S&P back at 5525. Dow Industrials up 231, up 0.6%. The Nasdaq Composite Index up 2.5%. The Nasdaq 100 Index, full of big tech names, up 2.8%, while the Russell 2000 now advancing by 1%. 10-year yield 4.10% with a 2-year 4.35%. Gold up 0.6%, 24.25 the ounce, and West Texas Intermediate crude surging 3.7% now to 77.47 a barrel. Boeing shares up 3.3%. Boeing has appointed Kelly Ortberg as its next CEO, entrusting a retired veteran of the aviation industry with one of the most complex turnaround challenges in corporate America. The plane maker made that announcement as it reported a steep loss in the second quarter. Boeing shares, though, higher, up by 3.4%. Recapping, stocks are advancing across the board, with the S&P now up by 1.7%. Balance of power continues. Back we go to Washington. Once again, your host, here he is, Joe Matthew.
All right, Charlie, we do thank you and appreciate your joining us here on the Wednesday edition of Balance of Power on Bloomberg Radio, on the satellite, and on YouTube. Yes, I'm Joe Matthew in Washington. We're going to send things back to New York about an hour from now, just to give you a sense of what's coming today for special coverage of today's Fed meeting that is driving a lot of the talk here on Bloomberg, of course, throughout the day. 2 p.m. announcement. You'll hear the news conference with Jay Powell live as well. Our own Michael McKee making his way over to the Fed for what I'm sure will be probing questions, with our eyes also not only on the campaign trail, but what's happening abroad. Says it all here on the terminal in a single story. Strikes on Israel's enemies in Tehran and Beirut raise tensions, with Israel demonstrating its willingness to risk retaliation after the targeting within just a few hours of senior Hamas and Hezbollah leaders abroad, raising the prospect here of regional conflict. So it happened again. Around this time yesterday, we were talking about the response, the retaliation against the Hamas, Hezbollah bombing, rather, of the children and teenagers on the soccer field. Now we're talking about a strike, not on the Beirut suburbs, but in Tehran itself. The leader of Hamas, the political leader, Ismail Haniyeh, assassinated in the early hours of the morning in Iran, according to Hamas. And we need to be clear, while this is being referred to as an Israeli airstrike, the IDF has not, in fact, confirmed that it was their doing. And that's where we start our conversation with Holly Dagris. We had to go to an expert on this, editor of the MENA Source and Iran Source, senior fellow in the Middle East programs at the Atlantic Council. Holly, it's good to see you. Thank you for coming back. Should we assume this is Israel?
Well, I would say that Mossad's been treating Iran like its playground for many years now. They've played a role in sabotage on Iran's nuclear facilities, defense facilities, the assassination of top nuclear scientists, and even the stealing of sensitive nuclear files. So I think a lot of folks are pointing their fingers at Israel given that context.
It's pretty bold to strike in Tehran itself.
Well, not just that. The same day that was the inauguration of the country's new President Masoud Pezeshkian, with 110 foreign delegations in the country.
So there's now worry about the response to the response. What's about to happen?
Well, we've heard publicly from the Supreme Leader himself, Ayatollah Ali Khamenei, has actually said that he vows revenge. We've also seen that the United Nations, the Iranian permanent mission to the United Nations, has publicly said that they're going to engage in special operations, which I would say is a signaling to the West and Israel that they're not going to be directly responding like the way we saw in April, where Iran fired 300 ballistic missiles, drones at Israel directly, but it sounds like they're going to respond. It's just a matter of when and how.
And striking against an individual, this becomes a tit for tat?
It would seem very likely, because they do see this as an eye for an eye, and the fact that they didn't cite the UN Charter, which is what they did last time, which was they used international law to make their case, tells me that this is going to be a different kind of response than what we saw in April.
Yeah. To your point, Iran's supreme leader responding to say that Iran considers revenge as its duty, written on his official website. How do you read into that?
Well, the talk of revenge is very common with the Supreme Leader in these contexts. He also vowed revenge when the IRGC commander was taken out in Damascus at the Iranian embassy compound in Syria. That prompted the big tit for tat we saw in April. He's also said that in the context of Quds Force Commander Qasem Soleimani. So there's this sense that they have to respond, or else there's going to be seen as a sign of weakness.
Benjamin Netanyahu can relate with that. I started by referring to the risk that he's willing to take here in this case. What is going on inside the inner circle that surrounds Benjamin Netanyahu?
Well, we're nearly 10 months into the Gaza war that was prompted by Hamas's terrorist attack on Israel on October 7th. And while these have been ongoing, the key point of Netanyahu's strategy was to take out Hamas. And we've seen that not just Haniyeh, the political chief, was taken out, but reportedly Mohammed Deif, one of the key military commanders in Hamas. So in some ways, this is at least giving the appearance that they're actually making good on that commentary that they're going to take out Hamas. Not the ideology itself, but its leadership.
Well, so what do you make of this prospect? We keep hearing about worries about a wider war, that this could become a regional conflict that could even draw Iran and the U.S. Into it. But a lot of the smart analysis I've heard is that every party is trying to avoid that. It doesn't help Hamas, it doesn't help Hezbollah, and it doesn't help Israel.
Absolutely. I know, like, looking from the outside in, it's like, well, how is this not going to? All these different tit-for-tat strikes in various shapes and forms. But absolutely, none of these regional partners or foes want to see a wider war spread, because this would drag everyone in. It's not just an Iran-Israel thing. It's a Lebanon. It's a Syria. It's an Iraq item. So, and even the Gulf. And so one would hope that cooler heads will prevail. But this is why when you see the signaling from the Iranian emissions saying so publicly how their response will look like that, it's almost de-escalatory, even though they are going to respond. And this is exactly what happened in April.
That's fascinating. Is the U.S. Still in Benjamin Netanyahu's ear, or has the tension over this war with Hamas broken down the credibility of the administration when it reaches out to Netanyahu?
Well, I think one of the things that are really playing have complicated things is the U.S. election itself. We suddenly have a possible different Democratic presidential candidate with Biden no longer on the ticket. Differently. Yes. And so I think that Netanyahu is having to cautiously keep that in the back of his mind, like who will be in office come January.
Is he worried about Kamala Harris winning?
I mean, I would say that you're not going to see too much of a difference between the Biden policy, but at the end of the day, we really don't know what Kamala Harris's Middle East strategy is, except with the exception of her comments that were made after her meeting with Netanyahu last week. But when you're looking at the big picture with where things are going, I think that Netanyahu is having to tread carefully, because he also has to think about his own career, which is at risk as well.
Well, that's right. Kamala Harris is striking. Will say exactly the same thing word for word as Joe Biden, but will be applauded by members of the squad, and it will be interpreted differently. When she had those remarks following the meeting, she didn't say anything Joe Biden had not said before, and calling for a ceasefire, but it landed differently. Why?
I think the way she talked about the conflict itself, I remember reading some of the analysis was that it was seen as more balanced, because it wasn't talking just about what was happening in Israel, but what was happening with the humanitarian situation on the ground in Gaza.
She says our support is ironclad when it comes to Israel, right?
Correct.
So it's kind of the same message.
Yes, it's just, I would say, boxed a little differently, as you noted.
What's the message from Donald Trump? There's been talk of a feud between these two. They got back together at Mar-a-Lago. We all saw the hug. What's Donald Trump's Israel policy? Does Benjamin Netanyahu know?
Well, I think that Donald Trump, or former U.S. President Donald Trump's view is he's a deal maker. If this war drags on till, let's say, if he was to win the election come January, he's going to want to make a deal because he would like to win the Nobel Peace Prize.
He'd like the Nobel Peace Prize?
Yes, he's always seemed to hint at that.
By way of Israel?
I mean, he would like to be the peacemaker between to end the war, and I really think
is that a good thing?
I mean, nobody wants a war to go on, but I think that when Donald Trump thinks about the conflict, he's thinking about making a deal.
That's fascinating. And that would probably go for Ukraine as well, right? So he sweeps in, brings both conflicts to a close, wins the Nobel Peace Prize. That's the idea?
I mean, that in his world, potentially, yes.
In Kamala Harris's world, does the ceasefire happen before November? Is that something that Benjamin Netanyahu would wait to see?
Well, I think that the fact that Ismail Haniyeh was just assassinated, who was the chief negotiator, has definitely delayed negotiations. It hasn't ended them, but I think that may possibly go past November. Yeah. We'll have to see.
These are wild times to think that we're talking about this today. When we called you last evening, we didn't know what would be happening in Tehran. Definitely. And this really has become a day-to-day, almost hour-to-hour story, hasn't it?
It has.
All over again. It's great to have you back. Molly Dagres, Atlantic Council, thank you so much for the insights, as always, here on Balance of Power. These are the kinds of conversations with experts in their fields that we try to bring you every day here on Bloomberg. We'll assemble our panel next. Lauren Tomlinson is with us, along with Janae Wartell, with our eyes back on the campaign trail. An important moment for Kamala Harris in Atlanta. We'll get to that next as we update world and national news first. Amy Morris joins with headlines in the Bloomberg 99.1 newsroom in Washington. Hi, Amy.
Hi, Joe. Hamas political leader Ismail Haniyeh was killed in Iran early this morning. Iran and Hamas are blaming Israel for that attack. Israel's military has not commented. Secretary of State Antony Blinken did not address his death, but says the U.S. remains committed to getting a ceasefire agreement in place, regardless of what happens surrounding the talks.
I'm not going to speculate on what impact any one event might have on that. I've learned over many years, never to really speculate about that because we simply don't know.
The attack comes on the heels of an Israeli strike in Beirut, which Israel says killed a top Hezbollah commander, allegedly behind a weekend rocket attack that killed 12 young people in the Golan Heights. Kamala Harris has wiped out Donald Trump's lead in the 7 battleground states that could decide the 2024 election. The latest Bloomberg News Morning Consult poll has the race still at a dead heat, with Harris ahead of Trump by 1%. Bloomberg's Nancy Cook reports it adds to a trend.
I think that we saw former President Donald Trump be super dominant the first half of this year. And I think that what we're seeing now, based on our poll, but also other polls, is that Harris is going to give him, I think, much more of a run for his money than Biden did.
Bloomberg's Nancy Cook in Washington, D.C. Former President Donald Trump has some big money support of his own. Cantor Fitzgerald Chairman Howard Lutnick is hosting a $25,000 a head fundraiser for Trump this Friday. He says he would like to raise $10 million for the Trump campaign, and he says he wants to help any way he can, including with the Trump transition. Global news 24 hours a day, whenever you want it, with Bloomberg News Now. I'm Amy Morris, and this is Bloomberg.
It's 12:40 on Wall Street. We do check markets all day long here at Bloomberg. 1 hour, 20 minutes to go until the FOMC decision drops. The news conference coming up 2:30 p.m. Wall Street time. Stocks are pushing higher. S&P very close to session highs. A powerful rebound for the U.S. stock market amid a rally in beaten down chip makers. Case in point, NVIDIA up now by 11.1%. Here's where we stand. The S&P up 85, 55, 21 up 1.6%. Dow Industrials up 257 points, up 0.6%. And the NASDAQ Composite Index is up 402 points, up now by 2.4%. The NASDAQ 100 Index doing a little bit better, up 2.7%. And the Russell 2000 Index of small cap shares now higher by 1.1%. 10-year, 4.09%. The 2-year, 4.35%. Gold up $15 the ounce, up 0.7%. West Texas Intermediate crude oil up 3.9%, 77.63 for a barrel of WTI. Lots of economic data this morning. Among those reports, pending home sales, and they rose for the first time in 3 months. That story, here's Bloomberg's Vinny Del Giudice.
Home contract signings rose by almost 5% in June. The gains were broad-based across all regions, according to the National Association of Realtors. That's even with elevated prices and elevated mortgage rates. Another report today from the Mortgage Bankers Association shows the average rate on a 30-year fixed loan held steady last week at 6.82%. Rates had been as high as 7.9% last October. Vinny Del Giudice, Bloomberg Radio.
After earnings, Advanced Micro Devices shares up by 4.2%. Microsoft after earnings down by 2.1%. And of course, the big earnings event after the close of trading, Meta Platforms up now by 2.2%. So again, recapping a powerful rally underway on this Fed Wednesday. S&P up 84, up 1.5%. Balance of power continues now. Back we go to Washington. And once again, your host, here he is, Joe Matthew.
All right, Charlie Pellet, thank you for keeping tabs on the markets for us on this Fed day. We'll have a lot more, of course, in our special Fed coverage that starts less than an hour from now. You'll hear the announcement live. You'll hear the news conference as well with smart analysis that you would expect here, of course, on Bloomberg. Speaking of big rallies, the one in Atlanta last night, still echoing for the Kamala Harris campaign. If you do not know who Megan Thee Stallion is, you will have a hard time understanding what's going on here. The rapper, singer, performer, MC, actor, opening for Kamala Harris at the big rally last evening. They got into some interesting moments in a room that was packed, the biggest crowd that Kamala Harris has drawn yet, in Atlanta. And she took the opportunity, once the standing ovation ended, to address Donald Trump directly when it comes to a debate. Let's listen.
Well, Donald, I do hope you'll reconsider to meet me on the debate stage. Because as the saying goes, if you've got something to say,
say it to my face, she says. Donald Trump has been waffling a bit on the idea of a debate. We'll see if he has an answer for her today as we assemble our panel. Lauren Tomlinson is with us, Republican strategist, Claffey Communications president, and Janae Wartell, Democratic strategist, partner at ARC Initiatives. Lauren, I'm going to start with you. When you see a moment like that, I saw a lot of comparisons to Barack Obama 2008 last evening. Some actually were comparing it to the size, scale, and sound of a Trump rally. Is Megan Thee Stallion, and I'm using her as an example here, for the remarkable surge of activity on social media, gathering young people, signing up volunteers, is Megan Thee Stallion the greatest threat to Donald Trump?
Around replacing anyone from Joe Biden is really giving new life into the campaign. Democrats were suffering greatly from an unenthused base, and I think what you saw last night was a very energized, Democratic base coming out in support of a candidate. You have to remember that part of this is Kamala, part of this is generic D was polling above Joe Biden. So it's unsurprising that we're seeing this. And also, in particular, that 18 to 24-year-old age group is very enthused now, very eager to get out to vote. So what you see in the polling is we're actually looking at a tight race that is akin to pre-Joe Biden debate before Democrats kind of abandoned their candidate en masse. And so I think this is what we can expect to go forward for the next 97 days, right, until the election, is that both sides are going to be very enthused. I think it's right to compare that rally to what we see on the Republican side with Donald Trump. These rallies end up being more like parties and, conferences for the faithful to go and support their candidate. And that was definitely the vibe that you got last night from Kamala. So I think that you can expect that going forward. The question remains how the undecideds end up breaking.
Well, that's right. And I'll ask another question, too. What's it going to look like when Donald Trump speaks in that same room? Talk about a split screen on Saturday night. Janae, talk to me about what's going on here in this groundswell for Kamala Harris. People are referring to it as a honeymoon, a sugar high. What does it look like a couple of weeks from now?
Well, you saw tremendous enthusiasm last night. You saw voters and volunteers and activists from all across the state. Obviously, the metro Atlanta area was very much represented last night. I think you saw that, this has been a shot in the arm for Democrats and for the work to rebuild that coalition that helped elect Joe Biden in 2020. And I think what you also saw was a clear message. I think this is one of the first times where you really saw Vice President Harris really articulate the message that she's going to be taking to voters throughout this campaign. What is her plan for the economy? What is her plan to ensure that we're continuing to lower costs for family? And I think that that's a really important part of this. When we talk about how is the middle going to break and we talk about these undecided voters, a lot of times they want to hear the issues. They want to hear where candidates stand on the issues. So I thought this was a really great opportunity for Vice President Harris to make that case. And I think you'll see that as she continues to go on to these battleground states in the coming days and weeks, that she'll continue to make that case.
Lauren, bring us to the split screen on Saturday night. Donald Trump's going to work overtime to pack that hall. They're going to bust people in if they have to, and they may not have to. The lines to get into Trump rallies remain epic. What will the split screen look like, and what's he going to say about the vice president?
I think he'll have a very packed rally as well. He's, very popular in Georgia. Biden only won Georgia last election by 12,000 votes, so it's going to be very tight in that state. So he'll have a robust rally as well. It remains to be seen on how disciplined Trump can remain, because his winning message is on the policy and continuing to tie Kamala to the Biden administration's failures or achievements, depending how you're framing it. Kamala frames it as achievements as far as Build Back Better, Inflation Reduction Act, some of these other things that the Biden administration has passed that has led us to the current economic moment in which people are concerned about costs, in which people are concerned about their ability to get a home loan, to afford their lives, to afford childcare, to balance their budget at home. And so as long as Trump remains focused on those policy issues and ties it back to how people feel right now in this moment, after 4 years of a Biden-Harris administration, I think he wins the message.
The thing is, Janae, a lot of people need to get through the rhetoric first, and Donald Trump has not been cooling the rhetoric since Kamala Harris has come on the campaign. We've heard a lot of the insults, dumb as a rock, calling her a laughing Kamala. He had an appearance on Fox News' Laura Ingram's show last evening in which he suggested that Harris would not be able to stand up to world leaders because of her appearance. Quote, "She'll be like a play toy," he said in the Fox interview. They look at her and they say, "We can't believe we got so lucky." They're going to walk all over her. I'm going to point you back to another comment that he made. I believe it was on WABC Radio, a talk show in New York, in which he was talking about Kamala Harris's relationship with Israel and the Jewish community. Get a taste of this.
When she stood up with him, she wanted to get out of there so fast. You could see the disdain. Number one, she doesn't like Israel. Number two, she doesn't like Jewish people. You know it. I know it. Everybody knows it, and nobody wants to say it.
Janae, she's married to a Jewish person. What are we talking about?
Well, it's nonsense, frankly, that she hates Israel. Donald Trump has a long-standing hatred and disrespect for women. We've seen that in his rhetoric. We've seen that in his policies. We've seen that in his actions. And I think, frankly, this just underscores that having a woman candidate to run against really is just highlights, I think, how Donald Trump really feels about women. And I think that one of the things that this campaign is going to really highlight as Vice President Harris continues to take her message to the battleground states, highlighting the economy and her plans, her plans on other domestic issues, but also reproductive freedom and reproductive justice. What I think you'll see is that we'll continue to trigger Donald Trump, who will say all kinds of things, who will hurl all kinds of insults. And America's listening, right? Undecided voters are listening, many of whom are women in these key battleground states who are going to make a huge difference. But he's going to continue to mischaracterize her record. He's going to continue to say any number of things that are red meat for his base. But we know that everything he's saying is not true. And I think that voters are paying attention to that.
What do you think about this, Lauren? I don't think of you as a big MAGA Republican. Is Donald Trump's rhetoric the biggest risk facing his own campaign?
It always has been. That's why I said that as long as he can stay focused on the policy issues and where Americans are today and address the issues and make this a referendum on the past 4 years of Biden-Harris, then he wins. The minute that he goes into these personal attacks is where he loses. And so that's why, the campaign is making the strategic decision to put Vance out on the attack for Kamala, making him the one that's going and speaking to donors and eventually going out and speaking to mainstream media and let him be the attack dog. That's the right role. Trump needs to stay focused on the big picture here and stay away from these attacks because he does. He alienates people when he does this, and it's not a smart move.
Janae, Donald Trump's going to be speaking starting in just about 8 minutes if he's on time in a sit-down interview type of conversation with the NABJ, the National Association of Black Journalists, which has been criticized for platforming, as they say, in this case, the former president. Should this organization be interviewing him? What is this conversation going to sound like?
Well, I think it's important to hear from the candidates on both sides, right? I think it's important that they're able to make a case to voters. I think that, if this interview really does spell out a better vision or a better plan, I think the American people need to hear it. If it does, in fact, double down on rhetoric that we've heard, I think that the voters can decide. But I think the platform is necessary. I think hearing in this context from each of the candidates is important. And so I think whomever is able to articulate that most effectively, whether it be in this context or others, I think it just furthers the case that furthers the case and helps voters to make a decision.
We should note, by the way, NABJ kicked out a statement a short time ago about a potential event with Vice President Harris. This is something that's been on again, off again. They are currently, according to the statement, in conversation with the Harris for President campaign team to schedule a Q&A session. Lauren, how important will this conversation be with young black journalists today?
I think it's very important. I think it shows the outreach that the Trump campaign is doing to Black Americans and Black men in particular. It is really important that the journalists interview both candidates and that they receive the same amount of opportunity to speak to the American people. I don't think that you can just block out what the other side is saying. You have to take both sides into account, take both arguments into account in a free and fair election system. So I'm glad that he's speaking to the group. I was sad to see that there were so many people that were protesting it because, again, I think that you have to hear things even if you don't like the candidate.
This is a great panel today. They're going to come back in our second hour. Lauren Tomlinson, Janae Wartell, great conversation and smart insights today from our panel, with much more next hour as we count down to our special Fed coverage. If you're just joining us on Balance of Power, special day today, as every Fed day is at Bloomberg, 1:30 p.m. Washington time, Wall Street time. We'll be kicking things back to New York for special coverage. The Fed announcement, 2 o'clock, will carry the news conference after. Michael McKee in the room for us here with questions for the Fed chair. This is expected to be the moment many have been waiting for. Certainly the market thinks so. The S&P 500 up 1.5%, the NASDAQ up over 2% in advance of what everyone hopes will be the big telegraphing to a rate cut in September. Stay with us. We'll have much more in hour 2 on Balance of Power, from politics to business and back again. This is Bloomberg.
politics to the world of business. This is Balance of Power. Live from Washington, D.C.
It's been a seismic shift in American politics this past week, and now we can finally put numbers on it. Welcome to the fastest show in politics as Kamala Harris ties up the race, at least statistically, with Donald Trump in the latest Bloomberg News Morning Consult swing state poll. I'm Joe Matthew alongside Kaylee Lyons in Washington. And Kaylee, we're going to dig into the numbers here, including who voters trust when it comes to interest rates, prices of goods on this Fed day.
Indeed, an hour from now, we'll get an interest rate decision from Jerome Powell and Co. It is not expected that they will cut rates today, although if anything, the last few weeks have taught us that maybe the unexpected is to be just as expected as what is expected.
You just put that out there.
That was the riddle. Well, no, I'm just saying you can't rule anything
You're
out
not
these
the
days,
only
but it is
person.
September
Yep.
that markets are betting on for the first
You
cut.
seem
And of
pretty
course,
happy
we
about
know
it, too.
the Fed does not like to take the market by surprise.
Yeah, big telegraphing day to day. Michael McKee is in the room for the news conference. We'll get the statement and, of course, the nuance that follows with special coverage, like you said, just a half hour from now.
Indeed. And of course, the ultimate decisions that the Fed will make will affect voter feeling about the economy and could ultimately have an impact on who wins the election, especially when we're looking at those key swing states, as you bring up that issue in particular. Georgia, neck and neck. Other states, Kamala Harris in the lead, and of course, Pennsylvania and North Carolina, she's still lagging behind Donald Trump. So we'll have much more on that ahead with Bloomberg's Wendy Benjaminson, our poll guru here. But first, our markets guru on this Fed day, Charlie Pellet. How are we looking up in New York?
Right now, a lot of green, a lot of electricity. Just under 1 hour to go ahead of the FOMC decision. Complete coverage on Bloomberg Television and Radio. And yes, 2:30 p.m. Wall Street time. We got Jay Powell's news conference for you, and we will have analysis after we hear from the Fed chair. So yes, keep it locked into Bloomberg for the very latest. Stocks ripping higher right now, staging a powerful rebound amid a rally in beaten down chip makers. Evidence, we got NVIDIA shares surging now by 10.9%. A lot of economic data this morning that has bolstered bets that the Fed will signal a rate cut in September. But to be sure, got to keep it locked into Bloomberg Television and Radio for the very latest. So here's where we stand. S&P right now up 85, very close to session highs, 55.21, a gain now of 1.6%. Dow Jones Industrial Average up 264, up 0.6%. NASDAQ up 404 points, up 2.4%. The NASDAQ 100 index up 2.6%. Broad-based rally on this Fed Wednesday here with the Russell 2000 weighing in. Small cap shares up now by 1.7%. Your 10-year 4.09%. The 2-year 4.35%. Gold up $15 the ounce, up 0.7%. And a rebound for crude today, now higher by 4%. WTI 77.74 a barrel. Brent, the global benchmark, back above $80 a barrel. 80.74, up now by 3.4%. After earnings, Advanced Micro Devices shares, they are rallying today. AMD now up by 4.5%. Microsoft after earnings heading the other direction, down 1.9%. And the big earnings event after the close of trading today, Meta Platforms up now by 2.3%. So again, recapping the Dow, the S&P, NASDAQ solidly in the green. S&P right now up 1.6%. Lots going on market-wise. Back we go to Washington. Balance of Power continues. Your hosts, Joe Matthew and Kaylee Lyons.
All right, Charlie Pellet, thank you so much. A lot going on indeed, and perhaps even more will be going on less than an hour from now when we ultimately get that rate decision. And of course, that will be followed by the press conference from Chairman Powell. All of it feeding into the economy, of course, which feeds directly into this election. And that was on full display in the latest Bloomberg News Morning Consult swing state poll that didn't just show Kamala Harris and Donald Trump in a statistical tie across the 7 states that will likely decide the election, but also showed where voters trust them when it comes to specific issues. On unity, Joe, Kamala Harris is the favorite. On immigration and on the economy, it is Donald Trump by a wide margin.
Yeah, you can drill down even more when it comes, Kaylee, to stock market performance. Trump 48, Kamala Harris 35. That's who do you trust more to handle? That's a wide disparity. 47-42 in favor of Trump when it comes to taxes and on this Fed day, interest rates. Trump 46, Kamala Harris 39. Maybe she should start tweeting at Jay Powell the way he used to turn those numbers around. It makes you wonder where the strength is coming from as she makes up for so much lost ground here. And to your point, Wendy Benjaminson has been all over this for us, Washington's senior editor and our polling guru here in the newsroom. Wendy, give us the big picture, because this isn't just making up ground. She's leading in Michigan by 11 points. What are the issues driving this?
Well, I think part of the issue is just the sort of excitement and energy that she brings to the campaign. It's like Democratic voters all over the country are saying, wow, now we got a race. Okay, let's all get in there. And we're seeing that in her fundraising numbers, $200 million in 1 week. 66% of them were first-time donors. We're seeing it in the poll among enthusiasm to vote now is up 65% of Black respondents in our poll said they were more motivated to vote now that she's in the race. Similar numbers for Hispanics and for young people of all races. These are the people that Donald Trump was just losing in droves. But to your point on the who do you trust questions, one of the things I should point out is that, yes, she is still well behind Donald Trump on economic issues and immigration, but she's ahead of where Biden was last month. So she's made up some of that ground. And now that we've gone through the, hey, gee, it's Kamala, isn't that exciting? Now she's going to have to start talking about issues, and we'll see where she goes with there.
Well, certainly we've already seen with the initial ad buys from the Trump campaign going after her on the issue of the border. We talked a lot about those yesterday. It is worth noting as well that, of course, this poll went into the field after we knew that J.D. Vance was alongside Donald Trump on this ticket. We still don't know who's joining Kamala Harris. We expect we'll find out within the next week. But how should we be thinking about the impact that could have?
The impact of her choosing a vice president, I think she really needs to look at the states where she needs to gain ground. We are looking very closely now at Josh Shapiro, Mark Kelly, and Tim Walz. And Tim Walz brings a sort of progressive energy that will help her sustain that young vote and the votes of people of color. Doesn't do much geographically. I mean, Minnesota has always been a blue state. Always has been, always will be, despite Donald Trump's efforts to turn it red. Pennsylvania, where Josh Shapiro is the governor, our poll shows she's still down there, probably because of her remarks on fracking, probably because unions aren't sure what to do yet. So she needs to make up a lot of ground there. But as you noted, immigration is her Achilles heel. It is the one thing that Donald Trump is just going to hammer on day in and day out, where Mark Kelly of Arizona could, as a moderate border state senator, help her mitigate that.
There's one number in here that I find interesting that's not getting enough talk, in my opinion. We talked about interest rates, the price of goods, a number of financial issues. There's one thing that touches all of us, and that's healthcare costs. And she's blowing Donald Trump out of the water on this.
Yeah.
Harris, 49%, Trump, 40%. Who do you trust more to handle healthcare costs? Almost a 10-point spread. Does he need to start talking about this in a different way?
Well, if he wants to win the trust of voters on those issues, maybe he should. But remember, he wants to end the Affordable Care Act.
Right.
He's been saying that for years. He said it all through his first term, and he couldn't get it done because Congress wouldn't go along. And he's doing it again this year, end affordable health care. That is the one thing she has already been hammering on in her rallies, is that he wants to end that. I'm here to help people, get what the care they need. I think she will focus much more than Biden did on the care economy, child care, housing costs, health care, elder care, the sort of things that families worry about every day, as opposed to Donald Trump's ideas of what costs, what is better for business.
All right, Bloomberg's Wendy Benjaminson. Marathon 24 hours for Wendy as we got this poll out into the world. Thank you so much. And of course, while we are listening to Wendy and detailing our polling that shows more enthusiasm among Black voters who suggest they may be more likely to vote now that Kamala Harris is in the race, it is worth noting that as we speak, we're preparing to hear from Donald Trump at the National Association of Black Journalists in Chicago, where he will be taking part in a moderated panel. Joe, of course, Kamala Harris is not going to be there today. It is planned, apparently, for a virtual or otherwise meeting in September, but it speaks to this notion that Donald Trump is trying to reach a certain demographic here. So on this note, let's assemble now our political panel. With us is Lauren Tomlinson, Republican strategist and Claffey Communications president, and Janae Wortel, who's our Democratic strategist today. She is partner at ARC Initiative. So Janae, obviously, while we wait to hear more from Donald Trump in Chicago today, we have heard a great deal from him over the last 24 hours. We've seen advertisements as well. I just saw a Kamala Harris ad, in fact, that was running during the Olympics. When we think about the messaging here, Harris still trying to introduce herself and Donald Trump already attacking her. How soon does Kamala Harris need to go on the attack in return?
Well, I believe that Vice President Harris is going to spend the next few days on the campaign trail, as you said, introducing herself to voters, making sure that they know who she is. Certainly, we're very familiar with her from her time as Vice President, but making sure that voters know her plan and how that may differ ever so slightly or in great measure from President Biden's policy stances on certain issues. I think that she has actually been in that time also taking an opportunity to demonstrate for voters what the contrast is, particularly on the economy, particularly on reproductive freedom. And I think that's been really important when she talks about not going back. She talks about not going back to many of the Trump policies that were failed. And also highlighting that former President Trump really hasn't outlined a vision for America that is progressive, that moves forward, but rather rehashing kind of some of his past failures as president in places where he really didn't get the job done. So I believe she's threading the needle and doing both, introducing herself now to voters, but also creating contrast early with former President Trump.
I want to ask you both about the results of this poll, Lauren. From the view of the Trump campaign, they can't be happy with what Bloomberg News and Morning Consult is finding here, particularly when it comes to some of the blue wall states, as Democrats call them, like Michigan, with Kamala Harris up 11. I don't know how far you're reading into that, but does this suggest a narrowing path for Donald Trump?
I think it puts us back pre-debate. So a lot of this is very similar to how tight we were looking at the blue states pre-Joe Biden's cognitive issues coming to roost. So I think that for the Trump campaign, yes, they're going to be concerned. Their advantage was just eliminated with Kamala coming in. But it doesn't change the strategy and the outreach that they're going to have to do to make sure that they make up these numbers and the targets are still the same. So they've got a lot of work to do. They've got to stay focused. And also, like we've been talking about, there's a huge enthusiasm boost right now. So who knows if Michigan, for example, stays at 11. I imagine it's going to come down a little bit as Kamala talks about the policy issues and all of these things that are going forward. But for the moment, the polls are going to reflect that enthusiasm boost, and they're going to be very, very tight. And any campaign is going to be concerned about that, but they've just got to keep doing the work.
So that's how Donald Trump may be looking at these figures. But Janae, what about if you're the Kamala Harris campaign, as nascent as it still is, knowing you have to make a vice presidential selection in just the next few days? We're expecting this could happen by next Tuesday. How could figures like what we're seeing in states like, say, Pennsylvania or Arizona or Georgia, for that matter, influence that decision?
Well, you have to look at what does a vice presidential pick really bring to the ticket, right? You're thinking about obviously your swing states where you have folks like Josh Shapiro, where you have folks like Mark Kelly, who are people who could really add and expand your map and make some of those tougher battleground states a little less tough. But you also have to think about what are the policy positions and the roles that they've played in governance that really do bring kind of that credentialing to your ticket. And so that's why someone like a Josh Shapiro or Mark Kelly really does rise to the top of that list, because these are folks who understand the nuance of policymaking. They understand, the interplay between the executive being an executive, but then, Mark Kelly also understands what it means to be an elected member of a federal chamber. And so I think that those that governance experience is really important. And the certain policies and leadership roles that they've taken up on committees is also a big part of this. And I think the third part, you've got to think about the coalition that they bring from their states, whether you're thinking about moderate voters, whether you're thinking about swing voters and your base voters as well. What do they bring in terms of helping you to shore that up? And we've seen that Vice President Harris has had tremendous enthusiasm in the base, but there is still that middle, right? There are still those moderate voters who I believe this vice presidential pick for her will have to help shore up.
Lauren, we've been talking about voters' propensity to trust Donald Trump more than Kamala Harris when it comes to economic issues, how to handle interest rates, the price of goods, the cost of services. There's a huge exception, though, as we just identified, and that's healthcare costs. Kamala Harris is trusted by 49% to Donald Trump's 40%, knowing he's been attacking the Affordable Care Act and has promised for years to put forth a proposal that would rival what many call Obamacare. Does he actually need to close the deal on that to shore up this number and put up a credible plan?
I think he would. But the thing about the healthcare numbers is I'm not sure that that's going to rise to a top 3 issue where they're going to spend a lot of time messaging about it. We consistently see in the polls that people are making their decision on the next president based on the economy, based on immigration, based on crime in their communities. And so while those top 3, it's kind of like the hierarchy of needs, while those top 3 are top of mind, healthcare, unity, fear for democracy, a lot of these other things fall to the wayside. They may came up in a debate, but we're not going to see the same impact that they had in Donald Trump's midterms, for example, when there was like a big healthcare scare among seniors, and that really flipped some of those congressional districts for Democrats. So I don't think that they're worried about it as much, but eventually he is going to have to address that because he's said multiple times that he doesn't want to take away healthcare. He wants to lower costs and those types of things, and he needs to say how he wants to do it.
Well, if we're thinking about healthcare policy, Janae, of course, it's been pointed out on that issue as well as others, including fracking, which our colleague Wendy just mentioned. When Harris was campaigning for president the first time around in 2019, she was adopting some of these more progressive liberal policies. It does feel that in some ways she is walking back from them now. How should she be towing that line of still trying to attract those progressive voters that she was in that primary back in the 2020 cycle versus trying to appeal to more moderates and without looking as though she's faltering on her own beliefs?
I think what's important here is to highlight, what she said on the campaign trail in terms of her record. But I think it's also an ability for her in picking a vice president to really embrace policies that may be a bit more popular in this moment, right? You have to be listening to the American voters and figuring out where the polling and the messaging is what the polling and the messaging is telling you. I know that this is obviously the early days of the Harris campaign, but I think this is also a moment where there's probably a fair amount of message testing. There's probably a fair amount of them looking at where the electorate's attitudes rest in terms of some of these more progressive and moderate policies, and how do they come down on a Harris for president messaging strategy that really speaks to where the voters are. And I don't think that really abandons any of the progressive values and views that she's presented. And I don't think that, is pandering to moderates. I think it's looking at where are the accomplishments aligned with her ability to get things done, and how to strike a new message that is right dead in the center of that.
Smart Talk with a great panel. Janae Wortell, Democratic strategist, partner at ARC Initiatives. Thank you, Janae, alongside Lauren Tomlinson, Republican strategist, the head of Claffey Communications, and a great conversation for our viewers and listeners today on Balance of Power. We are counting down to the start of our special Federal Reserve coverage. That's just a little over 10 minutes away. 1:30 p.m. Washington time will kick things to New York for special coverage with a Fed decision less than an hour away. Alongside Kaylee Lyons, I'm Joe Matthew. This is Bloomberg.
It's 1:21 on Wall Street from Bloomberg World Headquarters. I'm Charlie Pellet. It is Fed Day. That is looming over a busy period for earnings and a heavy news flow that just won't let up. Stocks are rallying. S&P right now up 88 to 55.24, a gain of 1.6%. Stocks staging a powerful rebound amid a rally in beaten down chip makers. Nvidia shares up 11.6%. Advanced Micro Devices after earnings up 4.3%. S&P up 88, a gain of 1.6%. The Dow up 0.7%, up 268 points. Nasdaq up 2.5%. The Nasdaq 100 index up 2.8%. And a broad-based rally today. Small caps taking part with the Russell 2000 up by 1%. 10-year 4.10% with a 2-year that's now yielding 4.36%. Spot gold is trading higher by $17 the ounce, up 0.7%, while West Texas Intermediate crude up 4.1% at $77.78 a barrel. Boeing has appointed Kelly Ortberg as its next CEO, entrusting a retired veteran of the aviation industry with one of the most complex turnaround challenges in corporate America. Boeing shares, they're up now by 4.6%. So again, recapping, stocks higher, S&P up 88, a gain right now of 1.6%. Balance of power continues. Back we go to Washington, and once again, your hosts, Joe Matthew and Kaylee Lyons.
All right, Charlie Pellet, thank you so much. I'm Kaylee Lyons alongside Joe Matthew here in Washington. We'll hand the baton to a special Fed Decides broadcast here on Bloomberg TV and radio just about 7 minutes from now as we await the Fed decision at 2 p.m. Eastern time. As we've discussed, they are widely expected to hold rates steady today, but there are some voices here in Washington that would like to see a cut happen now instead of waiting until September. That includes Senators Elizabeth Warren, John Hickenlooper, and Sheldon Whitehouse, who today, Joe, wrote a letter to Chairman Powell, as we have seen them do for a few meetings in a row now, urging that the data suggests the Fed should cut rates.
Yeah, look, there are some on Wall Street kind of quietly hoping for that today, too, right? You better believe Lindsay Owens has been making that call ever since we started talking with her several months ago. Executive Director of the Groundwork Collaborative, former Senior Economic Policy Advisor to the aforementioned Elizabeth Warren. Lindsay, it's great to see you. As we walk up to our special coverage here, what do you actually think will happen today? Is the conventional wisdom correct?
Yeah, look, the conventional wisdom is that they're going to hold steady, but I think all signs are clearly indicating that it's time for rate cuts. In fact, it may be past time for rate cuts. When I zoom out and look at the big picture for American consumers, for American workers, for American families, all of the data is saying it's time to cut rates now. We've got real softening in the labor market. Obviously, unemployment is low by historical standards, but we've seen it ticking up. We've seen those jobless claims ticking up. We've seen wage growth softening. We're also seeing consumers burdened by this incredibly high interest rate environment. Most Americans are not buying houses with cash. They're not buying cars with cash. In fact, they're putting a fair amount of their monthly expenditures on credit. And when the cost of borrowing is up this high, that's really squeezing families. And you've got to start wondering whether the interest rate impacts on families are outweighing the inflation impacts on families. So I think all signs are pointing towards rate cuts. And if we don't get that upside surprise today with an announcement of cuts, I think we better see a bigger set of cuts in September, something along the lines of 50 basis points.
Oh, wow. Okay. Well, we'll see if Chairman Powell is willing to commit to something like that or just suggest that they'll be data dependent. But Lindsay, considering you were just running us through data that you say does suggest the Fed should be in a position to ease here, the fact is the Fed has not prepared the market for that, right? Or do you think this time would be different in any way, that they would be willing to take the market by surprise?
Well, look, I think that the chair of the Federal Reserve has got to balance stable prices with maximum employment. That's his job. And I think doing that job well may require moving when the data indicates it's time to move. So, last time, at this time last year, the Fed thought we'd be in about 3.5% inflation. and we're actually closer to 2.5% inflation. So I worry that they are behind the 8 ball here. And with every passing FOMC meeting where they don't move to correct for being behind the 8 ball, the risks accumulate and compound. And I think, the biggest concern here is they put us in a recessionary environment, and they're, and it's too late to course correct. And so much better to course correct early than late, in my opinion.
When will we know, Lindsay, if it's too late?
Well, that's part of the problem here. You often don't know until you're already sort of boiling, right? The frog is in a pot of water, and you don't realize you're toast until you are. And so that's why I think when you look at the big picture here, when you look at the data, you have to balance all of the information. And what I'm seeing in the big picture for consumers, for workers, and for recession risk all points towards cutting rates now. The other piece of data that I think we have to look at is what's driving the remaining portion of inflation. And here what we see is that the lion's share of it is coming from housing and energy. And both of these two markets, both of these two sectors are not benefiting from historically tight interest rates. If we want to bring more housing supply online, if we want to get housing starts up, we've got to bring interest rates down. And if we want to start transitioning to a more resilient and clean energy future, we've got to also bring that supply online, get those investments in clean energy online. And the interest rate environment that we're really laboring under and suffering under right now is moving us in the opposite direction on both of those counts.
Well, it is interesting to consider. We got pending home sales data earlier this morning, Lindsay, which actually surprised to the upside in a big way, up 4.8% month over month. The expectation was for 1.5%. So maybe we are seeing some loosening up in a housing market that has been oh so very stuck for some time now, as we have that differential between mortgage rates you can get now and what you could get before this hiking cycle really started. Of course, we have to consider as well, as we talk about often here on Balance of Power, that we are in the middle of an election cycle. And if the Fed is going to signal cutting in September, perhaps if your suggestion is correct, as much as 50 basis points right before an election. We've seen elected officials suggest that would be viewed as politically motivated, problematic. Do you think ultimately that bears weight with Jerome Powell and his colleagues?
Yeah, I'm so glad that you raised this point, because we're living in this sort of Alice in Wonderland parallel universe right now where up is down and down is up. The fact of the matter is, if the data indicates that the Fed needs to cut rates, they need to cut rates. And not cutting rates when the data suggests that they should be cutting rates because of concerns about the election, that's the political move, right? The political move is changing course off the data to support a candidate or a particular economic atmosphere or a particular election atmosphere. So if the data says cut, they have to cut. And if they decide not to cut because of the election, that ultimately is a political decision. Their job is to follow the data and to follow their dual mandate of bringing Americans stable prices and maximum employment.
Lindsay, we only have about a minute left here. What would you ask then, Chair Powell, in the news conference to draw him out a little bit later on today following this decision?
Yeah, if I'm in the news conference and I know that, he's going to hold steady in July, I'm going to ask him if he can double down in September. What would it look like to do a 50 basis point cut in September?
All right. We'll see if that question gets asked. Lindsay, thank you so much, as always, for joining us on this Fed Day. Lindsay Owens, Executive Director of the Groundwork Collaborative and former Senior Economic Policy Advisor to Senator Elizabeth Warren, who, again, is encouraging Chairman Powell to cut
consistently.
Today. We're going to find out roughly 30 minutes from now whether that
Yeah, the building would
ultimately
shake. That would be like one of the old Greenspan surprises in the old days here. The markets are certainly expecting good news here, Kaylee. The S&P has been up consistently about 1.5%. The NASDAQ up over 2%. You hate to think of what might happen if investors do not hear what they want.
Yeah, and again, the Fed doesn't like to take the market by surprise usually. So how will Chairman Powell walk that line today? If he's signaling a cut is to come, how does he make sure not too much easing of financial conditions happens as a result? He's certainly going to be facing some very difficult questions in that press conference where, of course, our very own Michael McKee will be in the room for that as we are really just counting down the minutes here now to the Fed's decision.
Yep, leaving in good hands, of course, with Tom, John, and Lisa. And we'll meet you back here at 5 p.m. Washington time for the late edition of Balance of Power. We'll be joined by Libby Cantrell at PIMCO for her take on everything that is about to happen. So stay with us here with a special edition of Bloomberg Surveillance Ahead. The Fed decides. Tom Keene, Jonathan Ferro, and Lisa Abramowitz here on Bloomberg TV and radio.
Live from New York City for our audience worldwide, the countdown to the Fed decision starts right now.
This is a special edition of Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz. Bloomberg Surveillance, the Fed decides.
From New York City this afternoon, good afternoon for our audience worldwide. That decision 27 minutes away. Lisa, a decision followed by a Chairman Powell news conference 30 minutes later.
The key issue is going to be how do they message how much closer they're getting to September? Do they talk about strength and resilience, or do they recognize weakness as a feature that they want to lean into with the labor market?
My message 30 minutes away is simple. Not that I thought it'd be a snooze fest, John, but yeah, I was interested. Fine. Things have changed and changed dramatically in the last 24 hours. The yield market is screaming the importance of this meeting.
5 consecutive days this bond market has rallied, and over the last 24 hours, the last couple of weeks, we've had warning after warning from prominent economists saying that the Federal Reserve should reduce interest rates, not in September. Lisa, the call is for this meeting.
Although even those economists say that if the Federal Reserve were to lower rates today, it would spook markets and cause a pretty big risk-off kind of move that would be problematic. I've missed this. Honestly, I'm just looking out and I wonder, how do they cater to these people by saying we're definitely going in September, and this is a reason why we still want to wait until then?
I'm away from the parlor game dramatically here. To me, it's the markets talking, and I'm looking at the 10-year real yield very elegantly off the setup I have. I'm sorry, as you mentioned, John, 5 days in a row, lower yields. And the key question is, and we've got a guest qualified here to lean on it, is are we breaking out of the range finally to a new vector of disinflation?
The lowest 10-year yield since March. We're down about 2 basis points on a session this afternoon. Lisa, you missed the grunting. Is that what you missed?
Yeah.
The sound effects.
There's a lot of things.
The real-time sound effects.
John, we're doing a 4-hour meeting here. Show today. There's a lot to talk about here to get to September.
I agree. A baby step towards September is the bulk of what many people expect a little bit later on this afternoon. Let's give you a check on the markets beyond the bond market. Equities with a real lift on the S&P 500, advancing here by more than 1 full percentage point. The dollar just a touch stronger here, Bramo. The euro negative by 1/10 of 1%, 1.08.
We have a stacked lineup. Coming up just shortly, we do have Bob Michael of JP Morgan. The world is coming around to his view, and after that, we're going to be speaking with Matt Lazzetti of Deutsche Bank and Kathy Jones of Charles Schwab, taking us up to that Fed rate decision at 2 p.m. Eastern. Then, get this, immediate reaction from former Fed Vice Chair Rich Clarida, who has his own language to insert into the document that we're expecting to get from the Fed. I don't know if they're going to go with it. Diane Swonk of KPMG and Michael Gapin of Bank of America. And finally, following that news conference, this will be key, how he really guides the market heading into September and whether a 50 basis point rate cut is on the table, as some people are saying. We're going to be hearing from former New York Fed President Bill Dudley and BlackRock's Jeff Rosenberg.
Bill Dudley really changing the conversation in the last week or so. In a column on Bloomberg Opinion, TK, making a call. He said, I've changed my mind. The Fed needs to make a move.
So what you need to see a pivot like that, and it's not ex post. He's doing it in real time as the data comes in. And the huge theme today is this Latin idea. Michael knows the Latin, ex post, after the fact. We're going to wait. What are we going to do? Wait after September?
Bob Michael of JP Morgan Asset Management with us around the table. Bob, it's good to see you.
Happy to be here.
Good afternoon. Let's get into this Fed statement. Drops in about 25 minutes. What kind of changes are you and the team expecting?
Well, I think there have to be a couple changes. I think when you look at the first paragraph and they talked about modest improvement toward their 2% inflation target, I think you can say considerable progress to their 2% inflation target. They have to open the door to a September rate cut. I'm in the market, by the way, so I'm part of the market you talk about. I'm just telling you, if they cut rates today, I would be spooked. And I think they should have set us up to cut rates today, but at the last meeting. So don't do it now, get us ready. And then I think they have to focus on inflation and employment. They talked about being in better balance. Now, inflation is kind of where they want it. Employment, I don't know. It seems to be leaking oil along the way. So I think they should probably drop in better balance and just say pretty well balanced.
If he performs at the press conference in a Bob Michael manner, does that put a bid to bonds where we see yields drive ever lower?
I think so. I think you just have to appreciate no one likes yields at this level. We look at the Fed funds rate, it's 5 3/8. We want to buy the 10-year at 5 3/8 to 6%. We could do that in 1994 and 1995, but that ain't now. And the fact that we're at these levels and everyone's fighting it, and there's still $6 trillion in cash sitting there because they feel cozy at money market yields of 5 to 5.5% tells me there's still an awful lot of money to come into this market, plus everyone who's already in the market that took some profits.
Let's say Jay Powell doesn't want to spook the market, doesn't cut, but let's say he wants to dove it up. Let's say that he wants to really give a message that they are going to be accommodative. Could he open the door to a 50 basis point rate cut in September?
He could, he won't, because the other side of the coin is, while we're talking about the employment market is starting to leak a little bit, we're at 2.8% real GDP. You look at S&P 500 companies, close to half of them have reported, and 3/4 of them have beat the earnings estimate. So there is a large part of the U.S. economy that's doing pretty well right now. I don't think it calls for 50.
You said that you would be spooked if the Fed would cut rates today. Would you be spooked if they indicated a greater concern about an employment market that you say is leaky?
I think that would be a welcome acknowledgement of what we've seen in the labor market data, whether it's the unemployment rate now up 0.7% from the low, or when we look at the JOLTS data and the hiring rate has dropped and the quits rate has dropped. So there's some softening going on there.
If they've got unemployment year end at 4%, what's your underlying assumption, your base case for the labor market by the time we get to September, by the time we get to year end?
I think the unemployment rate goes a bit higher. I think you have to appreciate the policies that are in place today are restrictive. We're at 5 3/8% Fed funds rate. So that's brought growth and inflation down a lot. You can't just leave them there. And by the way, just bringing rates down 25 basis points, I don't know why the Fed is getting so wound up about that. They're just going from very restrictive to very restrictive minus a teeny bit. They're still in restrictive space.
I asked the unemployment question because I'm trying to work out whether this is truly a fertile environment for risk assets or not, and whether it will be by the time we get to September, October, November, December. If we're leaking oil now, where's the engine? What does the vehicle look like by the end of the year?
It's a Maserati driven by the FOMC with Fed in the driver's seat, and this is.
Should I be comfortable with that?
I don't know. You can look at that however you like. I tried to pick an Italian car for you. I know you appreciate that, but listen. This is 95 again, where things look pretty shaky, but they took pressure off of businesses and households and started to bring the Fed funds rate down. We're in a soft landing. 4.1% unemployment isn't 5.1% unemployment. It's leaking the wrong way, and they probably want to start pulling that down right now, or at least stabilizing things where they are. You can start doing that with series of 25 basis point rate cuts. They have that power.
At every single meeting for quite a while. That's some of the calls that we've been hearing about. What have you adjusted? How much you think the Fed's going to have to cut rates to deal with the leaky engine in the Maserati that John is driving to the Fed's decision later next year?
I don't think as much as the market thinks. I think we're probably looking at, I don't know, 75 to 125 basis points. I don't think this is 200 to 300 basis points, which is what they've done in the past, because I don't see recession. I actually see that there's still a lot of money sloshing around from the fiscal programs. It's still being tapped by state and local governments. They're spending it, they're hiring, and that's creating economic activity.
I got an email in here, Alex in Washington, and he was listening to Vice President Harris handle Bob Michael finance, investment, and economics, and it was not that good. I said, well, maybe Secretary Diamond will help. How political is this meeting?
Anytime you talk to a Fed official, they just bristle at the thought of politics behind it. I think they've got a lot of balls up in the air. They're at an interesting inflection point. If they had set the market up last meeting, they could have cut rates this meeting. They've got to get their messaging right for September. I think politics are the last thing on their mind right now.
Is this the way the Bank of England runs, John?
No. And, you know, if this was the Bank of England, we'd be talking about whether we'll get dissent in 20 minutes, and that question's barely come up, has it, Lisa, over the last few weeks?
No, but we also might be talking about a Liz Truss moment and how they respond to different political moments. So they don't have the privilege of acting recklessly, as one person I know tends to often say.
Who would say that?
I don't know.
TK brought up the politics. We can talk about a letter from Senator Warren and company, from the senators to Chairman Powell a little bit earlier this afternoon, saying maybe you should get a move on and cut interest rates. Bob Michael of JP Morgan is going to be sticking with us. Coming up in just a moment, we'll catch up with Kathy Jones of Charles Schwab alongside Matt Lazzetti of Deutsche Bank. Your Federal Reserve decision is around about 18 minutes away. And after that, a news conference with Chairman Powell 30 minutes afterwards. From New York City, this is Bloomberg. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
Bloomberg Power Players is back this September. As the top names in tennis take the court over in Queens, we are convening the best of the sports world right here in New York. We'll host some of the most influential voices in the business and identify what happens next for players and fans in this multi-billion-dollar global industry. Bloomberg Power Players, September 5th. Register now at bloomberglive.com/powerplayers.
Power, money, culture. As Linda Hammond tells the story of Asia's rise through the people who are helping to shape it. On this episode,
Asia's here. Asia is here.
inspired by the fusion of East and West,
I'm like the ambassador of the two worlds.
Hong Kong designer Vivienne Tam explores a future where fashion and technology meet.
When a lot of time people say, Vivian, it's not possible, I say, try it. It's possible.
Latitude, encore presentation this weekend, only on Bloomberg. Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, Tuesdays, only on Bloomberg.
You don't think the Fed is ready to cut?
See a July rate cut, I think would make me basically fall off my chair.
I think the Fed does cut in September.
September.
There's this growing dichotomy between Fed officials.
A lot of the kind of debate and discussion.
Those that are increasingly concerned about weakness, emerging weakness in the labor market, and those that are more focused on reinstating price stability.
I'm in the wait camp. The Fed can take its time. We just hope they don't cut too soon, should they cut in September.
We don't think they can go very far because of the underlying inflationary pressures.
I don't think the inflation drag has been fully slayed yet.
I certainly think the Fed has an argument to cut in July.
The labor market's feeling a little squishy here.
The Fed is late. They need to be cutting. If it's so obvious that you need to move in September, then what are you waiting for?
Mission accomplished. You've achieved your goals. Let's get going.
Let's get going. That's the Wall Street chorus. Make a move. in July. That July decision is 15 minutes away, but most people on Wall Street look for that move in September. Before that decision, going into it, the scores look like this on the S&P 500, a lift this afternoon, up by 1.4%. The NASDAQ ripping, up by 2.4%. Last time the Fed met in the middle of June, the Russell, the small caps, are up something like 10%. Over the same period, the two-year yield, switch up the board, it's down about 50 basis points. The two-year is down to 436.46. The 10-year is down for a fifth consecutive session at 411.23. And if you get to foreign exchange, we could talk about dollar yen. Lisa, dollar yen's an interesting one, gapping lower. This is a stronger Japanese yen to 150 off the back of a BOJ decision a little bit earlier. Will the Federal Reserve give them a helping hand in the next couple of hours?
That's the key. How much is this? Half BOJ, half cross your fingers and hope that the Federal Reserve is going to be dovish. What we got from the Bank of Japan was a 25 basis point. It was raising rates to 0.25%, which is the highest going back to 2008, and having their bond purchases. This was unexpected, moving in the opposite direction. That did some of the lifting now for the yen. Now over to you, Chair Powell, and I wonder if they're staying up late over there.
We know that Chairman Powell has one gear on Fed decision day for the last 6 Fed decisions. This started with some work that Alan Ruskin did over at Deutsche Bank. I'm going to go through each date of the last 6 Federal Reserve decisions and tell you what the two-year yield did on that day. June 12th, down 8 basis points. May 1, down 7. March 20th, down 8. The end of January, down 12. The December meeting, we were down 30 basis points. The November meeting of last year, we were down 14. The two-year has rallied at every single Fed meeting, Lisa, over the last 6. Is this meeting going to be any different?
Well, if you ask Neil Dutta, they should go right now, and it should be a similar type of rally. You raise a question, though. Have we already baked in the likelihood that they're going to pre-commit to September? Is there almost buy the rumor, sell the news when they actually come out and do give some sense of that, given how far the rally has already gone? I think it's fair to wonder whether this would be the one where you get some sort of break.
Let's get to the guest panel. We've got Bob Michael of JP Morgan alongside us around the table for the next 40 minutes or so going into that news conference. Joining us now is Matt Lazzetti of Deutsche Bank and Kathy Jones of Charles Schwab. Kathy, I want to come to you first and just get your thoughts on the changes you're expecting or not in the statement that drops in about 12 minutes' time.
Well, we'll be watching for comments around that big comment about, we do not at this time see the case for lowering rates. If that changes, that they say, yes, they are prepared, they are seeing the case for changing rates, that would be really significant. Then there's the description of the economy and the labor market in particular and inflation. Are we going to go from inflation remains elevated to simply inflation is zeroing in on our target? So if they remove the remains elevated, that would be a pretty good signal that the Fed is feeling comfortable about that. A little bit more complicated how they describe the labor market, since it has been growing at a pretty healthy pace, a pretty solid pace. I think last time they described it as strong, and yet the unemployment rate has been going up. So I'll be interested to see how they do that. So it's going to be very interesting to see how they word this one. I think there may be some pretty significant changes to the wording so the Fed can lay the groundwork for a rate cut.
Matt Lazzetti, are we seeing a disinflationary trend clearly in the market? Yields lower. It's pretty elegant, to be honest. And is that based off real and nominal GDP that's coming down?
So I think it is, but it's certainly based on the fact that inflation has decelerated. I think the most important data point that we've gotten since the June FOMC meeting was shelter inflation coming down, rent and OER at long last, finally confirming what we've seen from the private sector data. I think for the Fed, the one reason to wait to September is they want to get confirmation in that downshift in rent and OER inflation, especially after being burnt a few times on the inflation front. I think that there's probably some scarring effects to that. That said, the labor market is showing some weakening. As Chair Powell said, it's had considerable cooling taking place. And so we think the Fed waits until September, but once they start with rate cuts, they then move every meeting for the first few meetings.
Fed Chair likes to be a dove. John was pointing that out by how many times you see the two-year yield rally after a Fed conference for the past 5. Do you think that this time, he asked me this question, I answered, I'd love to hear your answer. Do you think this time could be different given the fact this market's already done a lot of work?
Yeah, I think incrementally he will sound dovish. So he's going to sound more dovish than he did at the June FOMC meeting, probably both from an inflation perspective and from a labor market perspective. Will that sound dovish enough from a market perspective? You know, the market is pricing more than 25 basis points for September. There is talks about moving by 50 basis points or so. It's not clear at all to me that he sounds dovish relative to that perspective. So we are pricing a lot. It's going to be hard for him to kind of move in that direction relative to the market pricing. I would actually take your kind of comment back in time. We've done a lot of research. If you go back to the late 1980s, the 10-year yield, basically the entire decline in the 10-year yield since that period, has happened within short windows around the FOMC meeting. So there's this very long-standing regularity with which yields decline around FOMC meetings.
Matt Lazzetti, I'm looking at the clock. I know you've got to run. It's got to catch up with this. Matt Lazzetti at Deutsche Bank, as we get closer to that Federal Reserve decision, about 9 minutes away. And this Federal Reserve seemingly becomes more confident about the outlook for inflation. Are they becoming increasingly uncomfortable with the outlook for the labor market? This quote comes from Neil Dutter of Renmac. Businesses are not desperate to find workers, and workers are not desperate to leave their jobs. Recruiting intensity tends to fall before firms resort to letting go of workers. Kathy, when you hear that, do you hear buy the 10-year bond in America?
Well, the 10-year's already discounted a lot already. I mean, where the yield is now has discounted several rate cuts and lower inflation. Having said that, I wouldn't be shy about buying 10-year yields here. I prefer probably closer to an average duration, closer to 5 or 6, but I wouldn't hesitate to buy 10 years right here. I do think there's still some downside in terms of yields, maybe down to the 380 area before this whole cycle plays out. But I wouldn't say it's the optimal place to buy treasuries.
You know, John started the show by talking about Bob Michael's direction and yield here. And Bob, I want to go there. Ian Lincoln at BMO Capital Markets as well. I hear so few people modeling out a sub 4% yield. And you get there on the ambiguity of Fed this, Fed that, and the other is a legitimate slowdown, as I said to Matt Lazzetti, in real GDP. Your Bruce Kasman published a global disinflation. Is that because of a global slowdown and all of a sudden we're at a 395 10-year?
Absolutely. You're also seeing it in commodity prices.
Exactly.
They're starting to drift lower. Yes. So there's a slowdown, certainly in China, also Europe, and it seems to be coming to the U.S. I would also argue that I can present a range of measures. We're already at the Fed's 2% inflation target. Let's pick one of their own measures, the New York Fed multivariate core inflation measure, 2.06%. That's within rounding error of 2.0%. If you look at the 3-month annualized rates of core PCE and core CPI, they're at 2.3 and 2.1%. So we're already there.
Well, and Lisa, I don't mean to interrupt, but I have to do this because John forces me to quote copper off the London Metal Exchange. Copper's down 11% with that commodity shortfall we've seen. Nobody's talking about that.
One thing that's not down is sort of the riskier credit aspect. And we've seen actually what's not down is small caps. And Kathy, I'm curious whether perhaps this market has overpriced the soft landing. That yes, we're getting inflation down already, as Bob was pointing out, to the Fed's target. And yet the weakness has yet to fully come.
Yeah, I think the tightness in credit spreads at the lower end of the credit spectrum is a concern. We're seeing bankruptcies are up among small businesses. We're seeing consumers having trouble with delinquencies on auto loans, credit cards, et cetera. Those are usually leading indicators of a turn in the credit cycle. Now, this one's been a little unusual, and that credit spreads continue to grind lower. But at some point, I think going down the risk spectrum is more of a concern that has played out in the market to date. So I would not be dipping down into those areas just on hopes that this is absolutely a soft landing. Right now, we're not calling for a recession, but the risk rises as you go forward, and you don't have a lot of risk premium left in those markets to cushion you if we do get a recession.
Bob, I'd love your take on this, not just whether we're going to have a recession or not, or whether this is a soft landing, but rather, is this market being overzealous in parsing out some sort of perfect scenario where credit can continue to do incredibly well, even in the riskier territories, even as you have slowing growth?
No, that's a soft landing. That's what soft landings are made of. It's great for markets. The Fed has done the impossible. I give them credit. I think it'd be interesting to hear from Kathy what her clients are doing. I suspect that they're not waiting for rates to come down. They're already putting money into municipal bond and U.S. Treasury ladders. So that money's starting to come in anyway. The Fed is going to be one of these lagging movers yet again.
You came very close to calling U.S. Treasury U.S. trash. And it made me wonder. Very, very close.
I thought it was U.S. tragedy.
I own a lot of them.
Trying to make some news here, TK. I do wonder what that looks like in 25. Had a lot of people talking about additional supply for the next 12 months. The supply story reasserting itself in the bond market. What do you say back to clients that bring up that one?
I think decisions that get made on Treasury supply are the worst things for investors to worry about. It's ridiculous. It doesn't move yields around at all. They price based on inflation and growth expectations. You look at where we are now, I can make the argument there aren't enough treasuries out in the market. The market's now scrambling to buy them 100+ basis points through the Fed funds rate. I think the other thing that gets forgotten here is that the Treasury is issuing to fund programs that the government is spending on. And that spending goes to hire people, create economic activity, and generate taxes on businesses and households. And I think that's what you see when the Treasury is telling you, actually, they're pulling back the amount of issuance in some of the coming auctions.
Kathy, I'd love you to weigh in here. Do you care about auctions? I mean, I care about auctions. I'm one of those people who focuses on absolutely the wrong thing. But Kathy, one of the reasons nothing changes, one of the reasons why is especially now after the Bank of Japan is making a move and not absorbing as much, there's a question not of whether people can buy, but whether they are more price sensitive. Do you think that's of relevance?
No, I have to agree with Bob on this one. I have looked at the relationship between auctions and yields for years and years and years over various time frames and not found a correlation. And I think he points out very importantly that the demand has grown along with the supply. Now, never say never. Maybe Japan will exit, their current policy much more quickly than we anticipate, and Japanese households will switch back. But there's still such a huge gap between U.S. Treasury yields and Treasury yields in other developed markets that I think for a price-sensitive or a yield-sensitive investor, there is a very long way to go here. So I would agree with Bob. I'm just not focused on the auctions or on the supply story.
Kathy, before you go, and we've got about 2 minutes left before that decision, Bob did ask a question of you and what your clients are doing. Are they starting to get that itch, starting to worry about so-called reinvestment risk and deploying some capital out along the curve beyond just, say, the front end?
Yeah, we've seen that. And it's been something we've been suggesting for a long time because we do see reinvestment risk when the cycle turns. So yes, we have seen a fair number of clients, heed that warning, and particularly using not just treasuries and not just municipal bonds, although the valuations there, if you're in a high tax bracket, can be pretty compelling on an after-tax basis, but also in investment-grade corporate bonds and other types of higher credit quality bonds where the yield curve's not inverted and you can actually hold on to some of these yields for 5 to 7 years.
Kathy, this was great. It's good to see you as always. Kathy Jones there of Charles Schwab, alongside Bob Michael of JP Morgan Asset Management. Bob's going to stick with us through this decision. On the other side, we'll hear from the former Fed Vice Chair, Richard Clarida. He'll be with us around this table in the studio. 60 seconds away. The scores going into it look like this. Let's start with equities, and then we'll turn to bonds. Equities are positive by 1.5% on the S&P. There's a strong rally in the NASDAQ. The NASDAQ 100 up by 2.5%. Before today, through the close of yesterday, we were poised for the biggest monthly loss of the year so far on the NASDAQ and the biggest monthly gain of 2024 so far on the Russell. The Russell 2000 up by another 8 or 0.9%. Switch on the board and get to the bond market. The 2-year, we talked about it. The 2-year has rallied, Lisa, at every single Fed meeting over the last 6. on Fed decision day? Is it going to be different this time?
Matt Lazzetti, I'm going to put this in his mouth rather than mine, was talking about how this could be just because we've already baked in more than a full rate cut in September and more than 2 full rate cuts by the end of this year. How much more can they deliver? That said, he has shown a willingness to really give a sense to what kind of weakness we see.
With your Fed decision, here's Mike McKee.
There is no change to interest rate. There are a number of small changes to the statement, but this is not a see you in September announcement. The Fed's forward guidance remains unchanged. Quote, the committee does not expect it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably toward 2%. There's also no change in the overall assessment that economic activity has continued to expand at a solid pace. All of the adjustments are basically to adjectives. Job gains have moderated, the statement says, instead of remained strong. Unemployment has moved up, but remains low. Inflation has eased over the past year, but remains somewhat elevated. And in recent months, there has been some further progress toward the 2% inflation goal. If there is a hint about the future, it's this. Instead of saying risks to employment and inflation have moved into better balance, the statement now says the committee is attentive to the risks on both sides of its dual mandate. The decision was unanimous, and that's basically it. If there is going to be a hint about a September move, it's going to be up to Chairman Powell.
It's a two-part story, Mike McKee. This was the first part. The second part starts at about 29 minutes with that news conference and Chairman Powell. Let's get to the equity market. We stay positive on the S&P 500, up by about 1.5%. On the NASDAQ 100, up by 2.5%. In the bond market, yields look a little something like this. We're down about 2 basis points on a 10-year. The move at the front end of the curve, it's a small one, but notable. Up by about 2 basis points on a 2-year at 438.32. I just want to get to those changes that Mike McKee identified. If you go back to the second paragraph of the June statement, the last line of that paragraph read as follows. The economic outlook is uncertain and the committee remains highly attentive to inflation risk. If you go to the second paragraph and the last line of the statement that just dropped, the economic outlook is uncertain and the committee is attentive to the risk to both sides of its dual mandate. And Lisa, this is the story of the dual mandate and the risks around it coming into balance. That looks like the way they formalized it this time around in the statement. And I just wonder how much the chairman builds on that in the news conference in 28 minutes.
I want to pick up on your point that the bond market isn't moving that much. There's only an increase of about 2 basis points on the front end. And that is why, exactly that. They recognize the risk that the labor market is one that they have to care about. This sets up Jackson Hole for him to come out and sort of change the framework. And then for September to be that first rate cut. No one's changing that view based on this particular statement.
The balance of risks has shifted and you start to see it appear just a little bit incrementally in the statement. The decision, rates unchanged. We're looking for a move still in September. To Lisa's point, we still have a news conference in front of us and Jackson Hole, the annual get-together in Jackson Hole, Wyoming, about a month away. With us around the table, I'm pleased to say the former Fed Vice Chair, Richard Clower, is with us. Still with us is Bob Michael of JP Morgan Asset Management. Rich, it's good to see you, sir. Let's start with you. You listened to Mike, you saw the changes in the statement. What do you make of what we just heard?
Well, I'm a bit surprised, actually. I mean, not with the adjectives. They needed to change some adjectives up, but I was a bit surprised about the reference to the attuned and attentive to the balanced outlook. I mean, that's certainly correct. The chair's been making that point, but I think it is relevant that they included it in the statement. He will certainly, I think, reinforce it in the press conference, and I do think it does tee up Jackson Hole. There'll be some more information before then.
I look at, and this show's the best one we've ever done. We've got Dudley with this important Bloomberg opinion piece a number of days ago. And I want to go to you on what you own, which is the high ground on the ex-ante, ex-post debate. You've got the Economist magazine article you did a year, whatever ago. You've got your January 2022 context and consequences speech. You want an ex-ante aspirational Fed. I don't hear that here. They're waiting, they're waiting, they're waiting.
They are waiting. I think they are getting greater confidence. But I think the key point, not to toot my own horn, is my view all along.
But it's okay. It's surveillance. You can do that.
My view all along, and I think I've said so on this show, is that the Powell Fed, really the goal was to get inflation to 2 point something, and then they would start thinking about the next step, which would be easing, not running an easy policy, but removing restrictions. So I do think this is what we're seeing. And if we do get the cut in September, as I think we and markets expect, it will be because they expect inflation ex antes to continue to fall.
But are we anywhere near that? I'm sorry. This is an ex post Fed going back to Arthur Burns. They're as data dependent as I've ever seen.
Yeah, they are data dependent, but I think that they attenuated and focused on the statement today, emphasized both sides of the mandate. So I do think they're looking at just the labor market as well as the inflation data.
Bob, what's your take on this? It seems like it's less dovish, a little bit more balanced than you initially thought. Do you think this just is trying to move as incrementally as possible?
I think they preserved full optionality heading into Jackson Hole. I also think that central bankers are mindful of what happened to the ECB earlier this year, where you could have made the same argument. If you're going to go next month, why not go this month? And then, of course, you saw what happened. So I don't see too much different than what we expected, other than they just decided to maintain the full optionality. We'll see what happens as we roll into September. We're still very much expecting 25 basis points in September.
Neil Dutta of Renmac just writes in, publishes, with language like this, it means the Fed will have to make a more pronounced shift in language in September. I'm surprised stocks are holding up well on this statement. Perhaps equities are looking ahead to the news conference. The news conference starts in about 24 minutes' time. He goes on to say, the Fed is waiting for additional data. Can they even articulate why inflation might reaccelerate from here? Can we pick up on that question, Bob? Can you articulate the risks around inflation? Why might it reaccelerate from here?
Corporate profitability still looks great. We talked about S&P 500 earnings. They're coming in ahead of expectations. You look at the guidance companies are giving you. They're up 12% next quarter. So we're not in a recession. We're slowing down in some parts of it. We'll see. I can't find really the argument what's going to cause inflation to reaccelerate, to be honest.
Well, Rich, we were talking about how this was definitely going to be unanimous. And I wonder how much of a wrangling of cats there is in the room, and whether this is basically a representation of that there's some members who believe that inflation has been killed. It is nowhere in sight, that labor is important. And then you have others who say, well, wait for the year-over-year comps. Is that kind of what we're seeing here?
I think it could be an element. We've had some members of the committee, and I know most of these folks, but it's a different committee than the one I was on, and many of them do emphasize both sides of the dual mandate. So I'm sure that reflects a number of folks' views. I do think, though, this is a committee that certainly got burned earlier in this year because the inflation data went the wrong way. And to their credit, they became very data dependent, as Tom indicated. I think that they, put it this way, I think they think they're going to go in September. There is a range of data where they wouldn't, but I think it's a pretty small range. And I think that's really the balance they're trying to strike. And I think we'll hear that in the press conference.
We were speaking earlier with James Bullard, formerly of the St. Louis Fed, and he was talking about how he always raised the question at meetings that if you wanted to cut rates, most certainly at the next meeting, why not cut them now? Bob was sort of discussing that earlier. And it sets up this sort of difficult period of time where every data point could potentially upset the apple cart if it doesn't comply. Do you think that they're in that zone right now?
I don't really. I mean, I've certainly, during my time on the committee, we found ourselves there a couple of times. So it can happen. I think the data we have gotten, the chair did a lot of communication before a blackout, and the data since then has reinforced that view. So I think there's a pretty wide range of data where they'll feel comfortable going in September. So I don't think they're in that danger zone right
Can you
now.
confirm that Jim actually said those things at the FOMC meeting?
Well, of course, I would never reveal what was said in an FOMC meeting except what I say, all the brilliant things I said. So
Diane Swog joins us now from KPMG, alongside former Fed Vice Chair Rich Clarida and Bob Michael of JP Morgan. Diane, I want to get into this statement that came out about 8 minutes ago. What do you make of it, the incremental changes, and were you looking for something bigger?
I wasn't looking for anything bigger, and I think one of the key issues here is we saw Powell talk about in his congressional testimony when pushed on the dual mandate. He said, listen, this is the thing that keeps me awake at night. The number one thing that keeps me awake at night is that overshooting, the over-tightening. So that is in there, and that is what opens the door a crack, not wide open, which is what we expected for September. And I do think they're going to move in September, and I agree wholeheartedly with Rich on this. I think the other issue is there's sort of this tale of two economies we're seeing emerge out there. The one that's in the household survey that's close to but not yet triggered the SOM rule, which is what got Bill Dudley up in arms, and how weak employment has been in the household survey, and the establishment survey, the GDP data, other jobs data that suggests the economy is still on solid footing. And right now, the Fed has been opting into more of that establishment survey where payrolls have held up, although they're not quite as strong as they've been. We're going to get probably some good public sector hiring in the jobs numbers on Friday again, which will help buoy those overall numbers, adding to some weakness in the private sector. But I think that's important, is that the Fed is looking at this and they're weighing which is the right stuff, and really getting to Rich's point too. There isn't just one piece of data that the market keeps looking for that could tip the apple cart. The Fed is looking at the totality of the data, and that last line really gets to that point. The totality of the data will allow them to go in September, and they don't want to make the same mistake the ECB made, move and then have to freeze and be in a purgatory. Their credibility is at stake. They want to make sure inflation is coming down, but I agree with Rich, they'll still cut before inflation reaches its 2% target, anticipating that the economy, by lifting off that restriction, the economy will get there.
We have Swank and clarity with this. Bob Michael, maybe a question for you on the economics of the moment. Are we slaves to measured? We have measured for decades. We're being very measured where maybe other central banks aren't. Are we just so afraid to move, and we're over careful, over cautious, because once we move, we've got to move in a measured vector?
I feel like we're back to the Greenspan Fed,
Yeah.
where every word is so carefully thought out. It makes you want to overanalyze it, and no one can give an inch. If the wrong word is in there, then the FOMC gets concerned about the market pricing in hundreds of basis points of rate cuts and risk assets being up tens of percent.
Okay, please go.
But we're talking about, and Rich touched on it, we're in, I think, very restrictive range. 25 basis points, right. You're not in a loose monetary world with money flooding all over the place. You're still restrictive. You've got to start that journey somewhere.
This is too important. Lawrence Meyer, Washington University, his monograph, A Term at the Fed. He tore Greenspan apart, that it was a dictatorship. Are we getting to the point now no one can dissent and everyone's measured because we're measured and appropriate?
No, I think no one has dissented because 2 years ago inflation was too damn high and they were all agreed they wanted to get it lower. It'll get more interesting as we get close. But what I want to say, to invoke the Olympics now, this is a Fed that really wants to stick the landing. They won't say this word, but their projection and what we're seeing in Bloomberg consensus and elsewhere is a soft landing, and they want to stick it. And, the data is now solid, is moving in the right direction. And so, getting back to the Greenspan Fed, there was a soft landing or so in those years. Alan Blinder's written, they're not, common, but we do see them. I think in 2019, I think the Powell Fed got a soft landing. We don't see it in the data because we got the pandemic. The economy looked pretty good in January of 2020. So they're trying to stick the soft landing.
Forget about sticking the landing. Let's just throw them in the Seine. The water's fine. We'll be okay.
You win. Better analogy.
Right.
Okay.
There's another analogy. Matt Hornback puts this out earlier, and I'd love your thoughts on this, Diane. Basically, the Olympic motto, to carry on with this, reads faster, higher, stronger together. Could have been used to talk about central banks globally altogether. Now, it might be more apropos, slower, lower, weaker together. Diane, how much is that looming over this Fed meeting? The idea not of synchronized swimming or synchronized rate cuts, but this idea of trying to sort of take an edge off for the rest of the world that really does seem to be dealing a little bit more with some negative growth.
I don't think that's the Fed's main concern, and I'm sure Rich will back me up on that. I remember seeing Ben Bernanke actually go after another central banker who said, you guys need to change your policy to help us out. And he said, that's not our problem, basically, at a Jackson Hole meeting. So that is not the Fed's primary concern. That said, a strong dollar helps us out down the road in keeping goods prices lower. So that helps the Fed out. I think what's more important here in terms of the Olympic analogies is that the road to gold is often paved paved with tears and obstacles. And I think people forget that, and I'm thinking of Simone Biles here. I'm sorry, she's my hero and heroine at this point in time. But I'm thinking about, soft landings. People forget that the 1994-95 situation, it looks great on paper. I lived it. I remember it. Rich, you lived it too. It was ugly at the time. Chairman Greenspan's reappointment as his third term as Fed chair was held up for 4 months in 1996 because he nearly crashed the economy in 1995, and people were so angry at him for not easing sooner. And it was his own colleagues, including Janet Yellen on the Fed, that got him to experiment with productivity growth and intense foreign competition, that bringing down inflation and allowing the unemployment rate to fall instead of using monetary policy to do it. That is really important to remember, is that soft landings are not easy. They look good on paper, but getting there can be a hard path.
Diana, where does the confidence come? Where does it come from that unemployment stabilizes at these levels and doesn't carry on shifting higher into year end? What underpins that?
Well, I think, I don't know if unemployment is going to stay there or not. It often moves up slowly and then moves up rapidly. All I know is that even Claudia Sahm, who wants the Fed to cut right now, has argued her own rule might not be applicable in the post-pandemic economy because of all the changes we've seen. We've seen much of the rise in unemployment has come from more people seeking jobs, an increase in the participation rate, particularly among prime-age workers. We've seen an influx of foreign workers, foreign-born workers, accounting for over 70% of the growth in the civilian labor force since February of 2020. That's helped to buoy the unemployment rate as opposed to a surge in layoffs. That doesn't mean there aren't stresses in the labor market. That doesn't mean there aren't still problems. But at the end of the day, what is it that people complain most about? They can complain most about the high level of prices still. And that's something that the Fed also has to keep in front of its mind. And I think that's where we're at. At the end of the day, we don't want to lose this and not hit that soft landing, but it's a rocky road to get there. I think we're still going to make it, given the fact that we saw the positive of consumers pushed back in the second quarter on price hikes, and retailers and producers capitulated. They rolled back prices on goods, and we saw a rebound in growth, doubling the pace of the first quarter, driven in large part by a rebound in consumer spending. That's the Goldilocks scenario towards a soft landing.
There's this issue, Bob. We're looking at market pricing, and right now it seems like this is consensus, that they are going to land the soft landing, even though it is sort of a rarity or a white elephant. Do you think that the market has overpriced that soft landing or even underpriced it because the internal skepticism just keeps on roaring?
No, I think the markets are right on track with the soft landing. And if it in fact happens, the Fed can bring down rates a fair amount, and the markets will continue to appreciate. I think what's different this time is the Fed and investors have a lot more real-time information. I was around in 94, 95. I was around in 81. And you didn't have that information. And now you have it. It's real time, it's live, you can see what's going on. Businesses have it, households have it. And maybe it gives policymakers a false sense of comfort, but they have that sense of comfort.
Which really kind of leaves the market kind of in the way, sort of in the same boat that the Fed is in. And I wonder, Rich, if you were still on the Fed, how much the Fed looks at the market to kind of gauge progress, sort of follows them, if you will, because they are gauging real-time data. And if anything, this is the collective will. And I love the war stories from the mid-1950s from everybody. But I wonder if that's something that they could really kind of sink their teeth into.
Oh, sure. Well, I mean, I'll just speak for myself, but you're looking at the market, hopefully to try to extract signal. There's always noise. You have to be honest with yourself. But it's particularly relevant for things like the growth outlook and the inflation outlook. You need to know what is being expected. That's a key input to monetary policy, our expectations. I gave one of my speeches at the Fed was on this point of avoiding the hall of mirror problems by looking at market prices. So I'm not saying it's easy, but I don't think there's an alternative.
I want to cross back over to Diane. Diane, I know you've got to go in a second. Just a quick final word. A question for Chairman Powell in this news conference. Diane, what would it be?
Well, this is on communications. I think it's going to be very hard for the Fed to communicate. We're already seeing financial markets are trying to front-run the Fed on a larger cut in September. Yeah. How do they calibrate their communications to deal with what may be more measured cuts?
Interesting. Diane, thank you. As always, Diane Swankler of KPMG. If you are just joining us, welcome to the program. The Fed decision came out about 20 minutes ago, unchanged on interest rates, and the statement largely unchanged as well, just some incremental changes. So the focus on the news conference now, which starts in about 10 minutes' time. With us, joining us now, I'm pleased to say, is Mike Gapin of Bank of America. Michael, going into this news conference, very incremental changes in that statement. Were you expecting more than what they delivered?
No, I wasn't. I think with the strong growth numbers we received, the right place for them to make adjustments is exactly where they did. Reflected a little bit in cooling labor market conditions, reflect a little bit more progress on inflation, kind of pin down and nail down that balance of risks argument, because that's what the chair had said in front of Congress. So I think this was the right incremental move. I think the Fed feels that it's in a sweet spot right now, that the data is moving in its direction, so it's getting closer. It just needs a little bit more, and then that confidence, that nebulous confidence, may be there. So this is what we were expecting. We weren't expecting a big lean in either direction from the statement.
The market, as you know, Mike, has been looking for September and a baby step towards that. You and the team have been looking for December. What separates you at the moment, Michael, the data that backs up your view? What separates you from the rest of the street at the moment?
Well, I'd say we have less concern about downside risk to the economy. We certainly are watching for it and looking out for that we may be wrong on this view. But the economy grew at a pretty solid pace in the second quarter. And yes, things are moderating and cooling, but I still think that there's a lot of resilience to both the economy and labor markets. And we'll see. Maybe there's a little unevenness in this inflation story. But certainly a September cut has moved a lot closer to our baseline. So yeah, we're still in December, but we've got 2 employment reports and 2 inflation reports between now and then. Further progress in those 2 variables, a little bit weaker employment, kind of repeats of what we just saw in June inflation, that could easily put a cut on the table in September. So September can happen, but it may not. So I think that's how I'd frame it right now.
Michael, let's just put a bow on this. What does further progress look like to you in the 2 labor market reports, the 2 inflation reads that we get until the next meeting?
Well, I think the labor market report is maybe a little more asymmetric. A strong report is probably not going to prevent them from cutting, but obviously a weak one could. So if they feel the labor market is softening more than they expect, they could go in that regard. Otherwise, I think to your earlier question of what's going to cause inflation to rise, I can't see it. I agree, but I don't think what they can rule out right now is that inflation settles in at a level that feels a little uncomfortable for them. So I think on the margin, a little more evidence that no, we're not going to get stuck with, say, core PCE in the high 2s. It does look like it's moving lower. So 1 or 2 more reports that give them confidence about that, then I think is probably enough.
Speaking of discomfort, we know a topic they're uncomfortable with, and that's politics. And if it comes up in this news conference, we know what Chairman Powell's going to do. He's going to ignore it. But there was a letter sent to him by Senator Warren and company. And TK, there's a quote in this letter. The immediate press release read as follows: "The failure to cut rates would indicate that the Fed is giving in to bullying and is putting political considerations ahead of its dual mandate to promote maximum employment and stable prices." So you've got the Republicans saying if you cut rates, it's political, and you've got the Democrats saying if you don't cut rates, it's political. Sort of stuck in a rock and a hard place between the both.
And what's important here, John, it's so important, is that Richard Claret is one of the people that brought history back to economics with his work at Columbia. I sat at the Fed with you in that magnificent library of first editions, and Elizabeth Warren reached down and said, take the book off the shelf. And I took Torsten Veblen, The Theory of the Leisure Class, off the shelf, and you and I were talking about it. This is a few years back. That's what Senator Warren's talking about, is the Gilded Age. Are we in a Gilded Age where the elites are talking only to the fancy people and indirectly doing monetary policy only for the fancy people?
Well, no, in one word, I think, the Fed has the dual mandate. Inflation was too high. They're focused on both sides. I think the economy's in a place where it can certainly adjust and wait another 2 months until the cuts commence. So I would push back on that.
Mike Apen, would you push back? Just how relevant is the U.S. election and U.S. politics?
Well, the way I would frame this, and I think Rich would agree, I was formerly on staff at the board, and I learned quickly that no matter what you do or don't do, somebody's going to be upset, and one side will complain or the other will complain. So I think you learn quickly the best thing to do is to do what you think is right. So I would put it at that. So they have competing opinions here. The right thing to do is to do what they feel is right.
Mike, I'll finish with the same question I finished with Diane Swung. Questions for the chairman. If Michael McKee's listening, going into this news conference, what's the number one question for you?
Well, the chair has said that they could ease if there's unexpected weakness in the labor market, which is actual data that comes in below their expectation. But what about preemptive easing on the risk of labor market weakening? I think that might get at the gap between market pricing and what the Fed thinks it will deliver.
Mike Apen, thank you, sir. Michael Apen there of Bank of America. The news conference about 5 minutes away. Bob, there is a question here about what kind of interest rate cut it would be when we get one, if we get one, in September. Is it a risk management decision? Is it a mid-cycle adjustment, the beginning of something much bigger than that? Do you think they have to frame it at this point? Do you think they have to characterize what it might be?
I think they do, and I think they'd like it to be part of the normalization process, that they've achieved their targets on both sides of their dual mandate, and they could start to bring down what is a restrictive policy.
Michael Gapin echoed your speech of January 2022. It's about ex ante aspiration. I don't want you to voice for the chairman. I know that's inappropriate. But how does he voice the aspiration of getting out front here in 6-7 minutes?
Well, I think he'll stick to the mandate, and he'll stick to documenting the progress. And again, he won't use the word soft landing, although that's, I think, what they're trying to achieve. And I think Governor Waller's done a very effective job in his many speeches in making the point that they have time because the data is holding up quite well. It was a very bold call a couple of years ago for Waller to say we can disinflate without this huge pain in the labor market. I think they were prepared to take it if it was required. It hasn't happened. And so now I think they're even more focused on the soft landing. And I do think they do want to avoid a premature declaration of mission accomplished, because even if underlying inflation is going to target, there's always noise in the data. And 2 or 3 months of noise on the wrong side is a bit uncomfortable.
Rich, there's this feeling baked into markets that Fed Chair Jay Powell is much more dovish than the statement might suggest. Are you expecting that tone to kind of come out in the news conference?
Interesting. We heard a lot from Chair Powell at Centra on Capitol Hill, sitting down at the Economic Club of D.C. I've gone through and looked at that. I would actually expect him to stick pretty close to that, which was very balanced, not declaring victory, but acknowledging progress, emphasizing, as the statement does today, that they are really attuned and attentive to both sides of the dual mandate. So there are some times where I think the press conference is really the chair using a lot of, this is what I think. I think we'll hear a lot of this is what we think today. I think the committee's pretty tightly aligned on where they are.
Bob, what are you listening for today?
I actually think he will come out a bit more dovish. I think that's the way he's rolled the last several meetings. He's surprised us by deviating from the script and indicating that, he could see rate cuts on the horizon. I can't take my eyes off of the last sentence in the second paragraph, where the committee is attentive to the risk of both sides of its dual mandate. I got what I wanted, at least, which is acknowledgement of risks in the labor market. The more I look at that, the more it's clear to me that they're going in September. If I were Mike McKee, a lot of people tried to press the Fed on what their neutral long-term rate is. I would ask him, at what level is the Fed funds rate no longer restrictive?
Do you think they can answer that, Rich?
Well, I think they won't answer that. I think they have and this is one where there are probably 19 different opinions on the committee. One thing I'll say a little bit is right now, as I look at my Bloomberg screen, or I did 25 minutes ago, September was more than 100% priced, and even I wouldn't say it's 100%. There's data we could get between now and then where they might not go. So that's why I skew a little bit to being a little bit more balanced than maybe dovish, but we'll find out.
I'm pleased you brought up Sintra Portugal, because I think it's really important to reflect on the comments from Chairman Powell back in Sintra Portugal at the ECB's annual get-together. Chairman Powell was talking about the strength of the labour market, and the strength of the labour market being a reason for them to wait, that they have time. They can wait and see. A few more months of data, maybe. And it's his characterization again in this news conference of the labour market that I think matters, off the back of that incremental change in the statement that you're all picking up on around the table, that last line of the second paragraph. You've seen this incrementally in the Fed speeches over the last few weeks, Lisa, the last month. They're placing greater emphasis on the other side of the mandate in a way that it wasn't even part of the conversation a year or so ago. Think about where we've come from. 2 years ago, Jackson Hole, August 2022, pain to get inflation down. The focus was getting inflation down. And you can start to hear the focus shifting to the labour market. Let's take a listen to the chairman of the Federal Reserve, Chairman Jay Powell.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Our economy has made considerable progress toward both goals over the past 2 years. The labor market has come into better balance, and the unemployment rate remains low. Inflation has eased substantially from a peak of 7% to 2.5%. We are strongly committed to returning inflation to our 2% goal in support of a strong economy that benefits everyone. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. We are maintaining our restrictive stance of monetary policy in order to keep demand in line with supply and reduce inflationary pressures. We are attentive to risks on both sides of our dual mandate, and I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP growth moderated to 2.1% in the first half of the year, down from 3.1% last year. Private domestic final purchases, or PDFP, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal of underlying demand, grew at a 2.6% pace over that same period, the first half. Growth of consumer spending has slowed from last year's robust pace, but remains solid. Investment in equipment and intangibles has picked up from its anemic pace last year. In the housing sector, investment stalled in the second quarter after a strong rise in the first. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In the labor market, supply and demand conditions have come into better balance. Payroll job gains averaged 177,000 jobs per month in the second quarter, a solid pace, but below that seen in the first quarter. The unemployment rate has moved up, but remains low at 4.1%. Strong job creation over the past couple of years has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years, and a strong pace of immigration. Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed. Overall, a broad set of indicators suggest that conditions in the labor market have returned to about where they stood on the eve of the pandemic, strong but not overheated. Inflation has eased notably over the past 2 years, but remains somewhat above our longer-run goal of 2%. Total PCE prices rose 2.5% over the 12 months ending in June. Excluding the volatile food and energy categories, core PCE prices rose 2.6%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households and businesses and forecasters, as well as measures from financial markets. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. In support of these goals, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue reducing our securities holdings. As the labor market has cooled and inflation has declined, the risks to achieving our employment and inflation goals continue to move into better balance. Indeed, we're attentive to the risks to both sides of our dual mandate. We have stated that we do not expect it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. The second quarter's inflation readings have added to our confidence, and more good data would further strengthen that confidence. We will continue to make our decisions meeting by meeting. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we have seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we can maintain the current target range for the federal funds rate as long as appropriate. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we are prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to achieving maximum employment and stable prices over the longer run. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Gina.
Gina Smilek from the New York Times. Thanks for taking our questions. Markets pretty much entirely expect a rate cut in September at this stage. I wonder if you think that's a reasonable expectation, and if so, why not just make the move today?
Thank you. So on September, let me say this. We have made no decisions about future meetings, and that includes the September meeting. The broad sense of the committee is that the economy is moving closer to the point at which it will be appropriate to reduce our policy rate. In that, we will be data dependent, but not data point dependent. So it will not be a question of responding specifically to one or two data releases. The question will be whether the totality of the data, the evolving outlook, and the balance of risks are consistent with rising confidence on inflation and maintaining a solid labor market. If that test is met, a reduction in our policy rate could be on the table as soon as the next meeting in September. So you asked why not today, and I would just say, again, that the broad sense of the committee is that we're getting closer to the point at which it will be appropriate to reduce our policy rate, but that we're not quite at that point yet.
Howard.
So just to follow up on that a bit, if inflation behaves as you expect between now and September, would you regard a cut in September as sort of the baseline scenario right now?
So I guess I would think about it this way. I'll give an example of cases in which it would be appropriate to cut and maybe that it wouldn't be appropriate to cut. So if we were to see, for example, inflation moving down quickly or more or less in line with expectations, growth remains, let's say, reasonably strong, and the labor market remains, consistent with its current condition, then I would think that a rate cut could be on the table at the September meeting. if inflation were to prove stickier and we were to see higher readings from inflation, disappointing readings, we would weigh that along with the other things. I think it's going to be not just any one thing. It's going to be the inflation data. It's going to be the employment data. It's going to be the balance of risks as we see it. It's going to be the totality of all of that help us make this decision.
And just to follow up on that, specifically, in what ways right now, given all you've seen over the last few months in particular on shelter, on services, et cetera, in what ways are you not confident right now that inflation is on the way back to 2%?
I think it's just a question of seeing more good data. We have seen the last couple of readings have certainly added to confidence, and we've seen progress across all three categories of core PCE inflation. That's goods, non-housing services, and housing services. So it's really just, we had a quarter of poor inflation data at the beginning of the year. Then we saw some more good inflation data. We had 7 months at the end of last year. We just want to see more and gain confidence. And as I said, we did gain confidence, and more good data would cause us to gain more confidence.
Colby. Thank you. Colby Smith with the Financial Times. The March SEP pointed to 3 cuts in 2024 with core inflation at 2.6% and the unemployment rate at 4%. Since we're now at that level in terms of inflation and already beyond what was projected for the labor market, I'm just wondering if that rate path is back to being the best guidepost for policy rather than, let's say, the shallower one laid out in the June SEP.
So I would just say really the path ahead is going to depend on the way the economy evolves. And I can't really give you any better forward guidance on it than that. We didn't, of course, do an SEP at this meeting. We will do another one at the September meeting. I would just say I can imagine a scenario in which there would be everywhere from 0 cuts to several cuts, depending on the way the economy evolves. And I wouldn't want to lay out a baseline path for you there today. I've said what I can say about September and about today, though.
Nick Timmeros of the Wall Street Journal. Chair Powell, you've said before that you wouldn't wait until inflation got to 2% to cut rates because of how inflation has lagged. Does that apply for the labor market, too? If the labor market is back in equilibrium, why is restrictive policy and potentially very restrictive policy, given the high real funds rate, warranted right now?
So this is the very reason that we're thinking about that we've said in our statement that we're going back to looking at both mandates and that we think the risks are coming back into balance. We think what the data broadly show in the labor market is an ongoing gradual normalization of labor market conditions. And that's what we want to see. We've seen that over a period of a couple of years, and a move really from overheated conditions to more normal conditions. We are watching the labor market conditions quite closely, and that's what we're seeing. If we start to see something that looks to be more than that, then we're well positioned to respond. That's part of what we're thinking.
And when you talk about seeing something that's more than whatever softness or slowdown you expect, in the past, you've said that stronger growth wouldn't override better news on inflation. I wonder how that cuts the other way. If you're seeing more softness in the labor market than what you would expect, does that change the calculus on what you're looking for out of the inflation numbers to recalibrate policy?
So we have growth isn't one of our three. We have 2 mandates, as you know. The labor market, maximum employment is one, and stable prices is another. So we weigh those 2 things equally under the law. When we were far away from our inflation mandate, we had to focus on that. Now we're back to a closer to even focus. So we'll be looking at labor market conditions and asking whether we're getting what we're seeing. And as I said, we're prepared to respond if we see it that it's not what we wanted to see, which was a gradual normalization of conditions. If we see more than that, and it wouldn't be any one statistic, although of course the unemployment rate is generally thought to be a good single statistic, but we'd be looking at wages, we'd be looking at participation, we'd be looking at all the things, surveys, quits, hires, all of those things to determine the overall status of the labor market. But we're looking at it now. I would say, again, I think you're back to conditions that are close to 2019 conditions, and that was not an inflationary economy. broadly similar labor markets then. I think core inflation was actually running below 2%. So I don't now think of the labor market in its current state as a likely source of significant inflationary pressures. So I would not like to see material further cooling in the labor market, and that's part of what's behind our thinking. The other part, of course, is that we have made real progress on inflation, and we've got growing confidence there that we are not quite there yet, but we're getting more confident that we're on a sustainable path down to 2%. So those two things are working together, and we're factoring those both into our policy.
Chris Rugaber, Associated Press. You mentioned not wanting to see any further cooling in the job market. Why not, or would you consider preemptive cuts to prevent if you saw risks of an unexpected cooling? Is that something you would cut ahead of time for?
So I wouldn't say I wouldn't want to see any other cooling. It would be more of a material difference. If we'd be looking at this, and if we see something that looks like a more significant downturn, that would be something that we would have the intention of responding to. So in terms of, I don't think of it that way. I think of it as, we're actually in a good place here. We're balancing these two risks of, go too soon and you undermine progress on inflation, wait too long or don't go fast enough, and you put at risk the recovery. And so we have to balance those two things. That's the nature of having two mandates, and I think this is how we balance them. It's a rough balance, but it does feel like that. Again, the labor market feels like it's in a place where it's just a process of ongoing normalization. 4.1% unemployment is still historically low, and we'll just have to see what the data show us.
And just to follow quickly, wanted to see what you thought of the recent JOLTS report, which did show gross hiring has come down even below 2019 levels. Layoffs remain low, so it painted a picture of a very static labor market. Is that sustainable in your view, or something that is worrying? Thank you.
So I think all of the data points continue to point to kind of the direction we would want to see. So that was taken as there was a decline in job openings. That was good. Today's ECI reading was a little softer than expected, so that's a good reading. It shows that wage increases are still at a strong level, but that level continues to come down to more sustainable levels over time. That's exactly the pattern that we want to be seeing. So I think the data we've been seeing in the labor market are broadly consistent with that normalization process. Again, we're closely monitoring to see whether it starts to show signs that it's more than that.
Steve Leisman, CNBC. Mr. Chairman, back in March, you talked about cutting rates as a process, and in June, you talked about the idea that, well, one rate cut wouldn't do anything. So I wonder if you can sort of follow up on Colby's question. Talk about, are you weighing the economy right now in terms of its ability to withstand multiple rate cuts? Talk us through the process that you're thinking, or is it just one rate cut, or are you in the process now of thinking that rates need to be normalized here? Thank you.
Yeah, I can't really say that, honestly. We've seen significant movement in the labor market, and we're very mindful of this question of is it just normalization or is it more? We think it's just more normalization, but we want to be in a position to support the labor market. At the same time, we're seeing progress on inflation. So, we actually got to this. We raised rates a year ago at the July meeting, and if you look at the situation in the economy a year ago, inflation was over 4%. It was a completely different economy. Now we've made a lot of progress, and the labor market has, I think, unemployment was in the mid threes. So it's a different economy, and I think it's coming to be time to adjust that so that we support this continued process. The thing we're trying to do is, that we've had this really significant decline in inflation, and unemployment has remained low. And this is a really unusual and historically unusual and such a welcome outcome for the people we serve. What we're thinking about all the time is, how do we keep this going? And this is part of that. We think we don't need to be 100% focused on inflation because of the progress we've made, 12-month headline at 2.5, core at 2.6. You know, it's way down from where it was. The job is not done on inflation, but nonetheless, we can afford to begin to dial back the restriction in our policy rate. And I think we're just as part of a process. In terms of what that looks like, I mean, I think most rate, you know, you would think in a base case that policy rates would move down from here, but I don't want to try to give specific, you know, forward guidance about when that might be, because the pace at which it might happen, because I think that's really going to depend on the economy, and that's highly uncertain.
Rachel.
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. On inflation, do the past few months of good reports look like what we saw last year, where you really had a lot of momentum with a few bumps in between? Would you characterize that kind of momentum as back on track at this point in the year?
Actually, what we're seeing now is a little better than what we saw last year. Last year, as we pointed out late in the year, a whole lot of the progress we saw last year was from goods prices, which were going down at an unsustainable rate, disinflating at an unsustainable rate. This is a broader disinflation. This has goods prices coming down, but we're also now seeing progress in the other two big categories, non-housing services and housing services. So, you know, so the thing is, you got 1 quarter of that. We had 7 months of low inflation. You got 1 quarter of this. I would say the quality of this is higher, and it's good, but so far it's only a quarter. So I think you know, we need to see more to know that we're, you know, to have more confidence that we're on a good path down to 2%. But as I mentioned, our confidence is growing because we've been getting good data. And things like the ECI report and, frankly, the softening in the labor market conditions, you know, give you more confidence that the economy's not overheating. It doesn't look like an overheating economy. And it looks like an economy that's normalizing.
And if we were to think about the first couple of months of the year, is there any sense now that they were these blips that could have actually allowed for earlier rate cuts, as were some of the projections going into 2024?
So the thing about if what it is seasonality, and it could just be, it's very, very hard to, you know, to do appropriate seasonal adjustments. If that's what it is, then that actually implies that other months were under-reporting too low inflation. If you smoothed it out, it's a zero-sum game. And that's why we look at 12 months. We look at 12 months because that takes all that out, all those effects out. 12-month now is 2.5% headline, 2.6% core. This is so much better than where we were even a year ago. It's a lot better. Now, the job is not done. I want to stress that, and we're committed to getting inflation sustainably under 2%, but we need to take note of that progress, and we need to weigh the risks to the labor market and the risks to our inflation target now more equally than we did a year ago.
Michael McKee from Bloomberg Radio and Television. I'd like to ask you about the balance of risks as the American people see it. At this point, is the risk greater to leave interest rates where they are, given the damage that higher interest rates do to the economy in slowing demand and raising prices? Or is it more important for the American people that you keep rates where they are to bring inflation down?
I think that we've been given an assignment by Congress. This is how we serve the American people, is by achieving maximum employment and price stability, right? And so in our, quasi-constitutional document, the Statement on Longer-Run Goals and Monetary Policy Strategy, we look at the two goals, and if one of them is farther away than the other, the two variables, inflation and employment, if one is farther away from its goal than the other, then you concentrate on the one that's farther away, and you take account of the time to reach the goal. So for the last couple of years, the best service we could do to the American people was to focus on inflation. But as inflation has come down, and I think the upside risks to inflation have decreased as the labor market has cooled off, and labor market has softened, probably the inflation is probably a little farther from its target than is the employment, but I think the downside risks to the employment mandate are real now. So we have to weigh all that. And if you think about where that takes us, is we have a restrictive policy rate. It's clearly restrictive. It's been the rate we've had in place for a full year. And the time is coming, as other central banks around the world are facing the same question, the time is coming at which it will begin to be appropriate to dial back that level of restrictions. restrictions so that we may address both mandates.
Well, you have event risk, basically, with the jobs report on Friday and another one before you meet again. Are you certain that you won't fall behind the curve and lead to unnecessary unemployment if you wait until September?
Certainty is not a word that we have in our business. So we get a lot of data between now and September, and it isn't going to be one data read or even two. It's going to be the totality of the data, all of the data, and not just and then how is that affecting the balance of risks? That's going to be the assessment that we do. Of course, we'll all look carefully at the employment report, but so much other data coming in, and so much happening between now and the September meeting, and we'll make a judgment.
Edward.
Thank you, Mr. Chairman. Edward Lawrence of Fox Business. I do want to dig deeper on what Michael and what Nick were asking. There's a shift in the statement to balance between the focus between inflation and jobs. Looking at the job sides, we've seen wage data show sort of an abrupt slowing. We're hearing on earnings calls from companies like Intel abrupt layoffs. In the jobs report from the BLS, government jobs has been a leading creator. Could the government jobs as a sector hiring mask underlying weakness in the jobs report?
Well, we'll look at everything. We've seen some tendency to have a narrowing base of job creation in some months going back, but then we've had some months where job creation was broader, and also the headline number of jobs has come down. So but you look at the whole thing, and I think you do look at private demand extra carefully. To your point about government. So we'll just be looking at all those things.
So as a follow then, so could the Fed then be behind the curve? Because you said some of the reports, last meeting, you said the reports could be noisy or overstated. Was there a discussion of what kind of discussion was there for a cut today? And could the Fed be behind the curve?
Yeah, so look, the objective is to balance the two risks, right? It's the risk of going too soon and the risk of going too late. We've been, we had 7 months of good inflation data at the end of last year. We said we wanted to see more. We pointed out that too much of this was coming from goods, and sure enough, the first quarter wasn't great inflation data. Now we've got a quarter that is good, and we're balancing the risk of going too soon against the risk of going too late. That's what we're doing. There's no guarantee in this. It's a very difficult judgment call, but this is how we're making it. But in terms of today, your question about today, we did have we had a nice conversation about this issue today. The overall sense of the committee, as I mentioned, is that we're getting closer to the point at which it'll be appropriate to begin to dial back restriction, but we're not quite at that point yet. We want to see more good data. The decision was unanimous. All 19 participants supported it. But there was a real discussion back and forth of what the case would be for moving at this meeting. A strong majority supported not moving at this meeting. That was the strong sense of the committee. But it's a conversation that we had today, certainly.
Courtney.
Courtney Brown from Axios. Thank you for taking our questions. When the Fed was raising rates, there was a lot of conversation about long and variable lags. I wonder if that applies on the way down too. How are you and the committee thinking about that?
Yes, it does. And I think the lags have kind of showed up here in the last 6 months, by the way. You really do now see the restriction, whereas, even a few months ago, people were questioning how restrictive policy was. Look at the labor market now. You can see, and look at inflation, rate-sensitive, interest-sensitive spending. You really do see now that policy is restrictive. I wouldn't say it's extremely restrictive, but it's certainly effectively restrictive. Yes, the lag should be on the way down. It should take some time to get into the full economy, affect financial conditions, and that affects economic activity, hiring, and that kind of thing, and ultimately inflation. It's not instantaneous, although it's faster than it used to be because markets move now in anticipation of our moves.
So are you worried then that if monetary policy acts with long and variable lags, even when you're lowering interest rates, it might be too late for the Fed to help stave off any kind of slowdown in the labor market or broader economy?
Yeah, we have to worry about that. I mean, you're just to make it clear, you know, it's a very difficult, challenging judgment, and we don't want to go too soon. We don't want to go too late. But this is how we've made that judgment. I feel good about where we are. We're certainly very well positioned to respond to weakness with the policy rate at 5.3%. We certainly have a lot of room to respond if we were to see weakness. That's not what we're seeing, though. What we're seeing, look at the first half growth numbers. Look at PDFP at 2.6% for the first half. It's not signaling a weak economy. It's also not signaling an overheating economy. Labor market, admittedly, the unemployment rate has moved up 0.7, and we're seeing a normalization there. But wage increases are still at a high level. Unemployment is still at a low level. Layoffs are very low. Initial claims have moved up, but they're pretty stable, and they're historically not high at all. So the total scope of the data suggests a normalizing labor market. And again, we are carefully watching to see that continues to be the case.
Victoria. Hi, Victoria Guido with Politico. On the labor market, I was wondering, how worried are you all about unemployment rising to the point where it triggers the SOM rule? And would that potentially affect how quickly you cut rates?
So I would just say the question really is one of, are we worried about a sharper downturn in the labor market? So, and the answer is we're watching really carefully for that. We're aware of that rule, which is really I would call it a statistical thing that has happened through history. A statistical regularity is what I'd call it. It's not like an economic rule where it's telling you something must happen. So, again, what do we see? What are our eyes telling us? We look at all the things we're seeing, and what it looks like is a normalizing labor market. Again, job creation at a pretty decent level, wages moving up at a strong level, but coming down gradually. Job vacancies have come down, but they're still high by historical standards. So, again, I've been through some of the data already, but what we think we're seeing is a normalizing labor market. And we're watching carefully to see if it turns out to be more. It starts to show signs that it's more than that, then we're well positioned to respond.
Is there reason to think that the labor market might behave differently this time than it has historically?
I think, history doesn't repeat itself. It rhymes. I think that statement is very true about the economy. You never assume it's going to be just the same. An example would be, is there a trend increase in the level of vacancies? There are many, many examples, so it's never exactly the same. Also, let's remember that this pandemic era has been one in which so many, apparent rules have been flouted, like the inverted yield curve, for starters. So many pieces of received wisdom just haven't worked, and it's because the situation really is unusual or unique in that so much of this inflation came from the shutdown in the economy and the resulting supply problems in the face of, admittedly, very strong demand. So the whole situation is not the same as many of the other prior inflation or downturns that we've seen, or business cycles that we've seen. So we're having to learn, we're having to be very careful about the judgments that we make, I would say. So we don't assume that these regularities will just repeat themselves automatically.
Amara.
Thank you, Chair Powell. I'm Mara Mokwe with Bloomberg. There seems to be quite a difference between what the anecdotal data are telling us, such as the very recent downbeat beige book, and the hard data. Do you take those anecdotes seriously? That is, that the economy and labor market are cooling much more rapidly than what's shown in the data?
So I do take that seriously, and the beige book is great. What's even greater is hearing the Reserve Bank presidents come in and talk about their conversations with businesses and business leaders and workers and people in the nonprofit sector in their districts. But I'll tell you, it's a pretty, the picture is is not one of a slowing or a really bad economy. It's one of there are spots of weakness and there are regions where growth is stronger than other regions. But overall, it's again look at the aggregate data. Aggregate data is particularly PDFP, private domestic final purchases, is 2.6%, and that's a good indicator of private demand. So we listen to all of that, and it does. I think it's important to listen to anecdotal data and not just look at the aggregate data. Especially, it's very hard. GDP data can be volatile quarter to quarter. So it's just hard to measure economic activity. There are it's just difficult to do. So I look at both, but I wouldn't say that the anecdotal data is uniformly downbeat. It's more mixed.
Thank you. Jolene Kent with CBS News. Chair Powell, thanks for taking our questions today. You have consistently said that the Fed does not consider politics in making decisions. With a possible September rate cut on the table, it would be less than 2 months before the election, and former President Trump reportedly said that cutting rates so close to the election is something the central bank knows they shouldn't be doing. What's your response, and do you believe it's possible to really remain apolitical with a September rate cut?
I absolutely do, and I think it's first of all, we haven't made any decisions. I would say it this way: haven't made any decision about any future meeting. I don't know what the data will reveal or how that will affect the appropriate path of our policy. I really don't know. I do know how we will make that assessment. That's what I do know. So if you take a step back, the current situation again is inflation has come down much closer to our goal, and that's happened while unemployment has remained low. We're very tightly focused on using our tools to try to foster that state of affairs continuing. That's at each of our meetings, and all of our decisions are focused strictly on that and really on nothing else, doing our part, whatever that part may be. We're using our best thinking. We're doing our best to understand the economy. We follow academics. We follow the many commentators who bless us with their commentary. But we don't change anything in our approach to address other factors like the political calendar. Congress has, we believe, ordered us to conduct our business in a non-political way at all times, not just some of the time. I'll say this too. We never use our tools to support or oppose a political party, a politician, or any political outcome. The bottom line is, if we do our very best to do our part and we stick to our part, that will benefit all Americans. If we get it right, the economy will be stronger, we'll have price stability, people will find jobs, wages will rise in real terms, everyone will benefit. So that's what we believe, and that's how we will always act. This is my 4th presidential election at the Fed. I can tell you this is how we think about it. This is what we do. So anything that we do before, during, or after the election will be based on the data, the outlook, and the balance of risks, and not on anything else.
Just a quick follow-up. Do your economic forecasts and models take into account the two very different economic plans of these two presidential candidates, Harris and Trump? And if so, how?
No, we do not do that. We absolutely do not do that. We don't know who's going to win. We don't know what they're going to do. We don't act as though we know, and we just can't do that. We basically have our forecast. We can run simulations of different potential policies, but we would never try to make policy decisions based on the outcome of an election that hasn't happened yet. That would just be a line we would never cross. We're a non-political agency. We don't want to be involved in politics in any way, so we wouldn't do that.
Nicholas.
Thank you, Chair Powell. Nicholas Jasinski from Barron's Magazine. There hasn't been a dissenting vote on an interest rate decision in some time. If the data do evolve as you expect, if you do have more confidence by the September meeting, do you get the sense that there will be a unanimous vote on an interest rate move in September? Or basically, are there meaningful differences in committee members' assessments of how much more confidence is needed?
So there are always meaningful differences. There are, and we talk a lot before, during, and after the meeting. We do have a very robust discussion of these things. You're right that in most cases, people, if they feel heard and they feel that their position has been given serious consideration. For most people, most of the time, that's going to be enough. There are dissents. That's fine. No one has a veto. No single person has a veto. So it just is a question of who will vote for and against. We've had dissents. We haven't had so many during the pandemic era, and it just may be that we've felt more united because we felt under a lot of pressure to get things right. But before the pandemic, we had plenty of dissents, and dissents happen. It's part of the process. There's nothing wrong with dissents, and if it happens, it happens.
Jean. Hello, Jean Young with MNI Market News. Is a 50 basis point cut as a first cut at all likely or even on the table? Thank you.
I don't want to say, I don't want to be really specific about what we're going to do, but that's not something we're thinking about right now.
Jennifer.
Of course, I haven't made any decisions at all as of today.
Thank you, Chair Bell. Jennifer Schonberger with Yahoo Finance. Not to get into the minutes, but you said there was a real discussion today for moving at this meeting. I'm curious if you could provide some more color on the nature of the discussion today at the meeting about a possible rate cut as early as September.
Well, so, the way the meeting is set up, the first day there's a discussion of financial stability because it's every other meeting we have that. And then we have an opportunity to comment on that. Then we have an economic go-around. And then this morning we have the monetary policy go-around. And I think in people's economic go-around and in their monetary policy go-around, people express their views about this. And there's a range of views. People, as you will know from the speeches that they give, people have different ways of thinking about the economy. And so in the minutes, we'll lay this out in a much better way than I can do off the cuff. But there's a range of perspectives, and but I do think that we're a consensus-driven organization. People come together. This was a unanimous decision, and at the end, everyone supported the outcome, not just the voters, but everyone. So I would also say some people examined the possibility, the case for moving at this meeting, but overwhelmingly the sense of the committee was not at this meeting, but as soon as the next meeting, depending on how the data come in.
But there is a growing sense of confidence that you could move at the next meeting, assuming inflation comes.
Well, assuming that the totality of the data supports such an outcome, no question. That is the case. That as I mentioned, we think that the time it's approaching, and if we do get the data that we hope we get, then a reduction in our policy rate could be on the table at the September meeting.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. Former New York President Bill Dudley wrote an op-ed in Bloomberg earlier this month, which you probably saw, in which he said, quote, "It might already be too late to fend off a recession by cutting rates. Dawdling now unnecessarily increases the risk." Is he wrong?
So this is the judgment that we have to make, and we're well aware of the judgment. We're as I've said, we have to weigh the risk of going too soon against the risk of going too late. If we go too soon, we can, we had a lot of advice, to go ahead and cut after the 7 good months of last year. We didn't. We said we needed to see more. Then we saw some higher inflation. We've seen 1 quarter of good inflation, and we've seen the labor market move quite a bit. And as I mentioned, I don't think it needs to, cool off anymore for us to get the inflation results that are related to the labor market. Not all inflation is, of course. So I think it's a difficult judgment to make, and what you see is the judgment of the committee is that that time is drawing near. That time could be in September, if the data support that.
And have the chances of a hard landing increased?
So I don't know whether they've increased. I think they're low. I think this is, you don't see any reason to think that this economy is either overheating or sharply weakening. That's just not in the data. right now. What's in the data right now is an economy that's growing at a solid pace, a labor market that has cooled off, but nonetheless, unemployment is low. You know, the data overall show a strong labor market, you know, so that's really what you see. It's neither an overheating economy nor is it a sharply weakening economy. It's kind of what you would want to see, but of course, the job is never done. You know, we're watching to see, you know, which way the economy heads, and I think if we are to respond to weakness, we're certainly, you know, well equipped to do that. But that's not what we're seeing. What we're seeing is strong economic activity and, you know, a good labor market and inflation coming down.
Greg.
Thank you so much. In the minutes of the June meeting that came out a few weeks ago, there was a discussion about communications, and some Fed officials said maybe the Fed wasn't as clear enough about its reaction function. And when I talk to the commentators who bless you with their comments, they say that they really don't have a sense of what is going to judge, maybe not the first cut, but the pace of the cuts going forward. They don't have a good sense of that. Is there anything you can say, like, how will we judge that?
Yeah, I mean, I think the reality is that forecasters, and this isn't just the Fed by any means, forecasters have been continually surprised by, for example, the strength of the economy last year. So I think we had to be pretty humble about giving forward guidance about this, that, and the other thing. We need to be pretty careful about that. And, you know, when you're saying you're going to be data-driven, of course, it's always what the data, how they affect the outlook and the balance of risks, but nobody has great vision deep into the future. In terms of a reaction function, that's a long time, you know, discussion that people have had forever. I think people have understood for a long time, actually, that we were very focused on bringing down inflation. Nobody was really confused about that. The data have, you know, again, you've seen significant improvement in inflation just for the last quarter. Markets move around on that, on the data, really, not so much. It's not really what we're going to do. It's more just that the data keep coming in, and markets are very, very responsive to that data right now.
Go to Jeff for the last question.
Thank you, Mr. Chairman. I'm going to change gears on you just a little bit from all of the rate talk and whatnot. With Fed now being in the books for a little over a year, there hasn't been a whole lot of talk about central bank digital currency, and wondering if you could give us an update on where things are with that. Is that considered a dead issue now? Is it still something that's being discussed within the committee, and what's happening with that?
It's not something that comes up at all in the FOMC. So more broadly, digital finance is an area that has really significant implications for payments generally, instant payments, and it's something that's going to really change the way it's going to make more efficient and hopefully safer and all of those things, the way payments are made around the world. And so we have people who are researching that and trying to keep up to speed, because we play an important role in the payments sector, both as a convener and as an operator too. In terms of a CBDC, there's really nothing new going on. There's not much going on at all. We don't have the authority to issue a retail CBDC that's available to the public. We're not seeking that authority. So what we're doing is keeping up with developments there. Pretty much every major central bank in the world is at least doing that. Some of them are actually seriously looking at implementing a CBDC. We're really not. We're really just evaluating, the story and what's happening out there. I think it's work that we need to be doing, which could be very beneficial down the road. But we don't have on a CBDC. We don't have any plan. We would need to go to Congress, and we have no plan to do that. No one here has decided that we think it's a good idea yet. Thank you.
That wraps up the July Federal Reserve News Conference with Chairman Powell. If you are just tuning in, welcome to the program. Let's wrap that up for you. This market got the dovishness it wanted to hear. The equity market's positive by close to 2% on the S&P 500. On the Nasdaq 100, up by 3.3. We're moving closer to cutting interest rates. September could well be on the table. Push that through the bond market, a fifth consecutive day of gains for the 10-year Treasury. Yields lower. We're down by 4 basis points on a 10-year. It's a break of 4.1%. So we've all got the same question, just how low is the bar for a rate cut in September? This is what the chairman had to say.
The question will be whether the totality of the data, the evolving outlook, and the balance of risks are consistent with rising confidence on inflation and maintaining a solid labor market. If that test is met, a reduction in our policy rate could be on the table as soon as the next meeting in September.
So let's talk about the calendar. The next meeting, September 18th, the data in between. August 2nd, this coming Friday, payrolls. August 14th, a CPI report. September 6th, the jobs report. On the 11th, another CPI report going into a Federal Reserve decision week. And most people assuming after that, Lisa, we're like this far away from that interest rate cut.
Especially at a time where there was a different type of language in this communication. We are not data dependent. They are data dependent. They're not data point dependent. They want to draw a distinction that one data point isn't going to throw them off materially. They repeated the totality of the data as well as how they just need to see the same kind of good data that they've already been seeing.
The time continuum to me was critical. I thought Steve Leisman's question was great about measured. He alluded to this. They're slaves to measure, John. That's all there is to it. I just don't know what else to say. I'll talk to Dudley about it here. To have Clarida and Dudley with us today is
fantastic.
It's just lights out. And I really, for those of you at Global Wall Street, what's coming up here with Dr. Dudley is required listening.
There was a fantastic line that came from Evercore's Krishna Gua. I want to share this quote with you. He thinks they've laid the foundations for a rate cut in September. I think a lot of people observing that news conference would agree. But this quote's interesting. We think in practice it's not very data point dependent and view the cautious evolution of the statement as intended to carry hawks along and avoid dissents, as was indeed the case today. Expect a clearer signal a month from now at Jackson Hole. I'm thinking about the minutes as well. I just wonder how well set the stage is for the Doves to dance and sing very loudly in these minutes that come out in a number of weeks' time.
I was very happy that the reporter asked him to elaborate on the fact that at this particular meeting, they did discuss the possibility of cutting rates, that there were a few members, but not the vast majority. Here is the question. How loud was that voice, and what did they have to give to those people to get on board with them in terms of this decision?
As you bring in Dr. Dudley, moments ago, the 10-year yield broke down to a 408.92. It's a new low yield. Could you imagine, John, what our shows are going to be like with a 399 10-year? I can't get there.
Where are we going to be in September? Where's the unemployment rate going to be in September? That's the big question I have going into the payrolls report this Friday. Bill Dudley got a shout out in this news conference. Bill Dudley joins us now, the former New York Fed president and Bloomberg opinion columnist as well. Bill, I want to go to your column that you wrote in the last week or so. It was quoted in this news conference. I'm sure you heard it. What did you think of the chairman's response to it?
I thought it was a fair response. I mean, this is my opinion, and the Fed is reaching a slightly different opinion. I mean, we're at a point where the risks are pretty closely balanced, and so the question is, do you go a little earlier or do you go a little later? I think, the reason why I thought it made more sense to go is that if the market's already pricing in September with a high degree of certainty, what are you really waiting for at this point? Why take the additional risk of, the economy deteriorating further? So, at the end of the day, it's probably not going to make a big deal, a lot of difference, but I think, given the fact that the market expects the Fed to cut, once that decision is mostly made, and I think you heard today it was mostly made, then why are you waiting?
Bill Dudley, your essay heard around the world, the single sentence, the Fed doesn't want to be fooled again. You've held court at Princeton, where the late, wonderful Daniel Kahneman held court. Here's Kahneman with Tversky. Decision makers know they are prone to regret, and the anticipation of that painful emotion plays a part in many decisions. How is regret aversion playing in to this massive data dependency ex post ballet?
what may be happening here is the fact that they got fooled on inflation, early this year, where the data came in bad, makes them, overly cautious that they're going to make this, that they could make the same mistake again by going early. I think it's, economists talk about recency bias. You put too much weight on the most recent experience. So this may be a case where they're not putting enough weight on the fact that, things are slowing and the inflation's coming down, and maybe now's the time to act. I think it was interesting. You got a question about the SOM rule, that the fact when the unemployment rate climbs above 0.5% on a 3-month moving average basis, you always have recession. He said he is aware of it, but clearly the Fed doesn't put a lot of weight on that risk.
Do you feel like we're getting closer to the moment where we will see real dissent on a committee that's being cobbled together and you can kind of feel the strains in some of the communiques?
No, I think what happened, today was basically the Doves got a pretty dovish statement and a pretty dovish press conference, and so they're sort of set on board, and the Hawks got more patience. And so when you arrive at the September meeting, assuming the outlook doesn't change in a material way, and that's basically what Paul was saying, it's not about a single data point. The outlook has to change in a fundamental way for the Fed not to go in September. At that point, you have something to basically give to both the Doves and the Hawks. The Doves, thank you for being patient. The Hawks, we waited, so let's go together unanimously at the September meeting. So I think I think there's a good possibility that you'll see a unanimous vote at September for a 25 basis point rate cut.
Bill, you brought up the SOM rule. The chairman also brought up the yield curve in this news conference as well, and highlighted the false positives we're getting from traditional indicators. Just to reflect back on that piece that you wrote for Bloomberg Opinion, can you walk us through why you do think actually the SOM rule does matter? That maybe we should have a little bit more of a focus on these traditional indicators still and not completely ignore them?
Well, if I can start with the yield curve, the reason why I don't think the yield curve is necessarily a good predictor is the yield curve is inverted because people think monetary policy is tight. So it's not the yield curve shape that causes the economy to weaken. It's the presumption that monetary policy is restrictive that causes the economy to weaken. Most of the time when the yield curve is inverted, monetary policy is tight, and so the yield curve is a good predictor. The SOM rule, I think, is a little bit different. It's basically saying once the labor market deterioration goes beyond a certain point, it becomes self-reinforcing. Essentially what I think happens is households hear about the labor market weakening, they pull back on their consumer spending, that causes businesses to pull back in terms of investment and hiring, and that leads to further weakness in consumption and then further rises in the unemployment rate. It's a pretty amazing statistical regularity that either rises less than 0.5% or next stop is a full-blown recession. There's nothing in between. The smallest increase in the unemployment rate, trough to peak, is either between 0.5 and 1.9 percentage points. There's nothing in the middle, which I think is pretty interesting statistically. Now, he did recognize that as a statistical, just a statistical result. There's nothing there's no economic law behind it. But the track record is 13-0. So, think about the odds of flipping a coin 13 times and coming up heads every time. After a while, you're sort of going to believe that the next flip is going to generate the same result.
Bill, take us back to first principles. Why can't they just cut and say one and done and we'll observe versus our addiction to measured?
Well, I think what will happen is once they start to cut, they'll probably keep going. Once they start to do the first rate cut, they basically decide that monetary policy, that we've accomplished our mission in terms of inflation and unemployment. Policy is restrictive, so we now have to go back to neutral. Neutral's not 25 basis points away. So if you have a rate cut in September, it's probably going to be followed by rate cuts, at least 1 or 2 more rate cuts later this year.
Bill, it seems like this was a setup for Jackson Hole. We've been talking about that. And it seems like there will be some sort of policy regime shift that we will observe in August. What do you think it will be?
I don't think that Powell really needs to say much more than what he said today, frankly. I mean, I think the changes in the statement and the press conference today basically tell you that September is going to happen unless the economic outlook changes materially. Now, that's possible. You could get a whole string of bad inflation numbers, or the economy could come in hot. But I think in the next 6 weeks or 7 weeks, is the outlook going to change materially? I doubt it. So I think regardless of what happens in Jackson Hole, I think the Fed's going to cut in September. I think, Powell will sort of check in at the Jackson Hole and basically, probably confirm that we're still on track for this result for a rate cut in September. But I don't think it's, I don't think he has to use it for that.
Well, although it's not just about September, it's not just about whether they're going to move again one more time this year. It's about what the destination is. It's about the pace. It's about what the goal is in terms of just the view of where the economy is. Bill, do you expect there to be any discussion about the terminal rate, about what it means to be neutral at a time where this is a very different economy than pre-pandemic?
Well, I would assume that once you get inflation, you're highly confident inflation is going back to 2%, and you think the labor market's in balance, then you presumably want to go back to a neutral monetary policy. And the question is, what's neutral? And that comes down to that whole question of what is the level of R-star, the neutral federal funds rate. I think that neutral is clearly, lower than where we are today, but is it 100 basis points lower or 200 basis points lower? That remains to be seen. So the Fed's going to be sort of feeling its way. Now, obviously, if we fall into recession, then the whole story changes. Because in a recession environment, the Fed doesn't want to go to a neutral monetary policy. They want to go to a stimulative monetary policy. So if we actually, if it turns out with the benefit of hindsight that the Fed is late and we have a mild recession, then the Fed's going to cut rates much more dramatically.
Bill, I've never said this. I've got Dudley, Krugman, and Blinder on the same page. Never did I think I'd say that. The money paragraph from your good friend Alan Blinder. Any such early cut should be accompanied by a warning not to expect a steady stream of rate cuts. He alludes to the ECB. Do we need some ECB religion at the Eccles building?
No, I think that the Fed will probably cut more than one, because once you start to cut, you're basically saying, I think it's time to remove monetary restraint. And monetary restraint is not going to be removed with just one 25 basis point rate cut.
Bill, great to get your thoughts. Appreciate it. Bill Dudley there, the former New York Fed president, weighing in on this Federal Reserve decision, as he got a lot of people talking over the last week about the need to move in July at the meeting that's just passed. I want to bring you a headline. Comes from the New York Times, and it reads as follows. Iran's supreme leader ordering a retaliatory attack on Israel. The New York Times citing 3 Iranian officials briefed on the order. This is what I can tell you about crude. Crude's been rallying all day, and the price of crude looks like this at the moment. Brent crude up by 4 percentage points. TK, you would often say overtaken by events. The last thing this Fed needs over the next month or so is an energy price shock.
I'm so glad you brought this up, Jen. We led off the show this morning with Ethan Bronner, our Tel Aviv News Bureau chief, encyclopedic on the region, and he says the position here now is unprecedented, and he made clear there's going to be immediate news following both from the north to Lebanon and the news that you just have from Tehran as well.
As we get those updates, we'll bring them to you. I just want to reset. If you are joining us, we've just had a Federal Reserve decision in the last couple of hours. Interest rates unchanged. Incremental changes to the statement. There was a sense that in September, the Federal Reserve chair would set us up for a rate cut in September. He took a baby step towards doing so, and the market picked up on things accordingly. Big rally across equities, on the NASDAQ, on the S&P, on a Russell. It looks like this right now. It fades just a touch, but we're still higher by 1.4% on the S&P. Bear in mind the NASDAQ was poised for the worst month of the year, and at one point in the last couple of hours was on course for its best day of 2024. That fades. We're back down to about 2.7% higher on the session on the NASDAQ. We referenced this stat a little bit earlier on today, a few times. We are now on course for the 7th consecutive Fed decision day rally on a 2-year bond. Lisa, that yield is lower by 6 basis points.
How much is this just that Jerome Powell tends to skew dovish, and how much is this that the market still has a probability or a possibility baked into what the yield is that the Fed could maybe surprise in a hawkish manner? Either way, this is a market that likes to hear Fed Chair Powell speak, and today was no different.
Mike McKee was in the room with the Federal Reserve Chair down in Washington, D.C. He joins us from the nation's capital now. Mike, you've just got outside. Walk us through your biggest takeaway from that news conference this afternoon.
Well, I think what you walk away with is what Bill Dudley was talking about. If the economy doesn't do something weird, change positions, change directions, then the Fed is going to be cutting in September. But there are a lot of potential twists and turns between now and then. Friday is event risk with the jobs report. And, of course, you just mentioned the situation with Iran. I don't think the Fed was taking those things into consideration today as reasons not to move today, but they do have to worry about them and what might happen. Right. So they will, at this point, be on a cutting course unless something significantly changes. And I think that was the message that Powell wanted to deliver. And I think Bill put it well when he talked about how the statement was skewed to the Doves a little bit, and the news conference maybe to the Hawks, and that both sides get something out of it.
Mike, you've been doing this for a few years. Back to McChesney Martin. We almost printed a 406 10-year moments ago. Can the bond market tell the Fed what to do?
Probably not. And one of the things that you have to keep in mind is that we have all this international news going on, and the U.S. bond market is the haven market. So a certain amount of what's going on today is probably in reaction to Israel and Iran, and a certain amount of it is the politics going on in this country. And then on top of that, what the Fed is considering and what the economic data are showing. But I suspect today's less about the Fed and the data than it is about other things, because the market had pretty much priced for a September rate cut. They didn't get any surprises out of the Fed today.
Mike, you're referring, of course, to the news that John broke about Iranian supreme leader ordering an attack on Israel for the 2 assassinations that Israel carried out. Right now, we're seeing crude markedly higher, particularly Brent crude. Mike, I wonder how this relates to what Fed Chair Powell has been talking about, that this is actually better inflation data today than it was, say, late last year or earlier this year, simply because it is not being driven by goods. It is being driven by the employment market. It is being driven by services. How much do you believe, based on those comments, this is a Fed that is willing to look through good side inflation and focus much more on something else?
Well, I think they are, especially if oil prices go up only temporarily. The problem is if oil prices go up for quite some time, then that feeds through into the real economy, particularly on the services side. You'll see surcharges by delivery companies, airline fares might go up, that sort of thing. So they're going to have to keep an eye on that. But their general instinct would be to look past any kind of energy price change that comes about that they think might be temporary. And at this point, we have been waiting for a major shift in energy prices since October 7th, when the first attack on Israel came. So we haven't seen it yet. Let's see whether this holds or not. And then the Fed would have to take it into account if it's still going on.
5% rally in crude today. Mike McKee, great work as always, sir. Appreciate it. We'll catch up with you a little bit later. This week's not over. Still got some work to do. The Fed decision behind us. Tomorrow, we'll get jobless claims. On Friday, we'll get a payrolls report. And we'll be catching up with Jeff Rosenberg of BlackRock. We can do that now. Jeff, at 8:31 on Friday, will this decision today to do nothing, will that look like the right one?
Well, it might look like the right one, but I think the point you're also getting to is that Friday, and we'll see on Friday as well, is going to be much more consequential. But I think the important point about how it's going to be more consequential is what we've heard from everybody so far, what we've heard from the chairman, and in the statement is this is very much setting the table for September. And the bond market had already priced that outcome. And so what you look at into Friday and the payroll is you're setting up the bond market, perhaps broader markets, for a very asymmetric outcome. If the data is much, much